We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. This is a pre-recording of a Twitter Spaces live event that we hosted. If you'd like to be a part of the next one, go on to Twitter/Palisades Radio, and you can be part of the conversation.
Maybe that's a decent place to start, Bob. You know, thinking about how busy you have been since, basically since the start of the banking crisis. Have you seen like just a major uptick in business?
Yeah, we've seen quite a bit in terms of not just buying of metals, but concern out there, people trying to understand the landscape, moving metals out of, we've been doing a lot of foreign, bringing metals in from outside the US, people that are nervous with just liquidity in general, having metals closer to home. I think the foreign storage idea sounded great on paper, but after people started realizing the exit strategy or how much the spreads are, and we got to see how countries reacted in COVID and the lockdowns. It's like, why not just have it at home again? You don't have to worry about filing Form 8938 and your FBAR and all that kind of stuff, and declaring it foreign financial asset, or is it held directly if you're storing it with a gold dealer? So all that kind of stuff. People are just simplifying their portfolios. And then we're also dealing with First State Depository at the same time, because the claim forms went out right at the end of February, and everyone has been filling those things out. And of course, we're paying for everyone who wants to store with us. We'll pay for the shipping to have those products and assets moved to us. So we're involved with getting accounts opened and then spearheading sort of this batch shipping process that we're looking at doing. So that's been sort of at the same time as then you have tax season on top of that. And of course, I run a hedge fund, so we're dealing with the full financial audit, and that all the responsibilities and the demands that come from just managing money, going into, within the 120 days of your end of your fiscal year, you have to basically have your full financial audit done and provided to clients as well as to the regulator. So we're dealing with that issue as well. So it's like, I don't know if I could take another banking crisis. But it's been exciting to say the least. I think with everything that's happening, I think there's a recognition. People are waking up and saying, hey, listen, I'm more concerned about return of my money at this point. I don't really care about maybe making a killing in the markets, or, I just want to make sure that, my nest egg's intact. And, with everything that's going on with Fed and all that kind of stuff, and pension plans that have been invested in a lot of this garbage, and these AT1 bonds that were supposed to be above, the equity holders, and they just got wiped out. That's going to be a lawsuit, and just all this type of stuff just drives people to simplicity and over time. And that's I think what the metals represent, at least on the physical front, when it's held directly. It just, you want to make sure that you hold it correctly. That's my big thing. It's always been my big thing. Risk management is something that you want to try to just be aware of your surroundings, know what you're invested in, so you don't run into any issues. I mean, this First State Depository thing, you're talking, from what I understood, is about 40 million in metals that are unaccounted for. I mean, I think it's like 870,000 silver eagles were missing. Insane. And this was supposed to be segregated storage as well. So you just got to be careful wherever you place your money. And then obviously you have the volatility of the markets as well. So it's just making people more jittery. And this is all part of sort of when I developed the depository back in 2008, and I was doing all the research in 2006 and seeing this is what systemic risk and counterparty risk look like. And there's no way to basically protect yourself in a truly systemic risk fashion, because you're stuck in these institutions, and you're basically, at some point, you're going to be asking for a bailout, even if got to see what happened just with these banks, and some of the on Twitter for the last 2 weeks, and it's bank this, bank that, everyone crying foul, and billionaires that are getting their saying, hey, listen, you got to bail me out, you got to bail out the system along with me too. I mean, the system isn't, there isn't enough money out there, and that's the worry that ultimately that the Fed has to make its decision. Do they bail out the markets, or do they fight inflation? And we're seeing the balance sheet start to increase again. I think it's taken out about 3 or 4 months of QT basically. The balance sheet's reflated back up because of some of the loan programs and so forth. And then you've had the Federal Home Loan Bank jumping into the fray, adding liquidity into the system. I mean, the reaction's fast, and I get it. They're trying to slow the contagion, but it's something that I think for investors creates potentially a false sense of security. I mean, right now we're coming back down on the lows on the banking index from last week. I mean, if this thing holds, that would be a positive, but if it breaks, I mean, it's going to get kind of crazy. I think that been lulled over the last 15 years that the Fed is always going to have our back and protect us. And that's where I think that's one of the problems we've created for ourselves is in today's world, there isn't that fear out there, even though the market.
And that's something that Powell has, specifically said that he wants to, basically come out against. I just wanted to interrupt you as well, Bob, to get your assessment of the contagion risk that's still out there. And O'Hare, I know you're listening, and I know you've done a lot of these spaces as well. And maybe you could weigh in here too. But Bob, what is your assessment of the contagion risk that still, exists here?
The scary part about this is right now it's solely a function of. Well, it was basically a balance sheet issue with regard to the asset values that weren't being marked to market. And of course, they couldn't hedge them because if they hedged those assets, they would lose that mark to market exemption, I guess you could say. So you had basically all these deposits that came in 2020, 21 with all the money printing. Banks were forced to go out the yield curve to get some type of return. And now that the Fed raised rates, as much as they have, it put everybody on the water. What's scary is, I think this is the shot across the bow. What's really scary is the impairment charges that may be coming with all these, with the mortgages and the housing market and commercial real estate, the moratoriums on for failing to meet your rent or paying your mortgage or your car payment. You've had a lot of these moratoriums that have put a sort of a floor under the market. Otherwise, you would have seen a lot more volatility. I mean, great statistic was that right now there's 23 million consumer loans that are now delinquent. I mean, you have to go back to 2008 when we were about 25 million or a little over 24 million in total consumer loans that were delinquent. I mean, the market is very weak under the surface if it wasn't for these moratoriums. And then you look at real estate. 20% of the real estate that has been purchased the last 3 years or so has been investor buying. I mean, and then you see the BlackRock and some of these REITs that have locked up in terms of cash distributions because of their portfolios. The real estate market is not the most liquid thing in the world, especially when you need to get out. And you haven't seen the impairments that go along with potential markdowns in mortgage-backed portfolios and that type of thing. And that's the part that, if you want to talk about contagion, I think that's the real risk right there.
Yeah, it seems like this, that duration risk on the bonds isn't just isolated to SVB, right?
Yeah, it's all over the place. I mean, some of the bigger banks didn't. I mean, you have to remember, the rules allowed the banks to basically, in 2020, buy as much treasuries as they want, and they didn't need to have that marked against the reserve requirements. That rule got repealed a year later, but it allowed this ballooning of treasury debt. And the problem you're running into now is with the Fed doing QT and so forth, who's going to buy all this debt, especially if we come off the debt limit and all of a sudden, the Treasury has to start issuing more debt, potentially for bailouts and all this other stuff to the banks and large players that may be impacted, or pensions that have been impacted. I mean, it was one of the Swiss pensions I was hearing, I guess, lost like $2 billion or something like that in over the last few weeks with this bank crisis. I mean, these have an impact that start to take away the chinks of the economy. It affects the psyche and confidence, which people aren't going to want to take that kind of risk. After you've just gotten belted with your portfolio, if you owned any banking stocks. I mean, once you almost want to hide under a rock, or maybe hide under some gold. So that's what,
a useless pet rock, maybe.
Right. Yep. Yeah. But,
yeah, that's a good point. But that's, and it's not just isolated to the banking stocks. And, it just doesn't, to me, it doesn't seem like this is going to be an isolated thing that doesn't affect or start to affect everything else. And maybe that's the recognition by the market that's seeing this risk and wanting to get into the metals. I know, things look somewhat overbought. I've seen a couple people on Twitter saying, don't enter here. It's overbought. This is too heated up in the metals. But at the same time, it's hard to think that this isn't one of the starts of the exact type of risk scenario that people want the metals for, right?
Right. What's interesting, and I put this out on Twitter last week, and I think this week as well, but the speculators and the commitment of traders reports went net short silver, meaning they were short more than they were long in terms of contracts, 2 or 3 days before Silicon Valley Bank collapsed. I mean, they were net short silver. And the only time they were more net short silver in the last 3 years was actually last September, and they missed the low by 1 day or 2 days. You couldn't make this stuff up. And so the market, and right now, the last commitment of traders report, which are now up to date, by the way, shows the managed money crowd is still net short. They're not on the long side of this market by any means. I mean, you have a lot of rocket fuel here if the market wants to readjust and start to say, hey, listen, maybe the risk to the economy and the Fed and all this type of stuff and the uncertainty that could start to unfold here, maybe we need to start moving the portfolio a little bit stronger to the long side of the market. I mean, you could be at 24.50 on silver very quickly, and all of a sudden now you're starting to attack that big overhead resistance. And if we break through that, you're looking probably the next part of the trading range will be 24 to 28. But that's how silver moves. It goes in spurts. It's not like gold or maybe like a sort of a 45-degree angle on a long-term chart. Silver is like one of those things that it goes dormant, and then all of a sudden it's like it wakes up and it just goes vertical. It's a frustrating asset to own because you're thinking, why isn't this thing moving? The world's falling apart. But that's just how silver is. It's really the hedges that blow up and the short squeeze that it tends to follow on the paper side is really what moves the price. More so, I mean, the physical buying has been tremendous. You've seen the SLV, a massive amount of metal leave the SLV, and you're asking yourself, or at least I'm asking myself, where is that metal going? Because silver price is going up, it's not going down. So it's not like people are walking away from the silver market. The issue is the demand for physical. And last time we've seen this big drop in SLV, like 20 million ounces, was back in August, September, when India was buying a lot of SLV, a lot of silver. They're looking for potential outlet or supply, and so it was coming potentially from SLV, and we saw that ultimately, and that filter through the LBMA charts that they come out at the beginning of each month, showing the prior month's inventory balances. And of course, we'll know a little more in a couple of weeks what the LBMA is doing in terms of their overall inventories. I would imagine it's going to be a pretty big drop because the physical market has just come alive, not just in the U.S., but globally. Europe has had a huge increase in buying activity, the same in Asia.
So, Bob, is it possible that silver didn't react as much as gold did really in the last couple of weeks here because of those short positions? And David, maybe you can weigh in on that. Thanks for joining us.
Yeah, to me, gold is a crisis asset. Is sort of the go-to asset that people look at from a macro standpoint as well as from a central bank standpoint. It's recognized as more of a financial hedge, I guess you could say. And silver is sort of it has great correlation, but silver is one that tends to play catch up. And when that thing starts to move, it takes like a couple days for it to really make a dent in terms of relative valuation compared to gold. But you're seeing silver in the last couple of weeks has actually outperformed gold from a standpoint. If you look at that gold silver ratio, it's been dropping. So it's not that it's not doing its job. It's just, I think, from a overall price standpoint, silver is more than 50% below its all-time high, where gold's 3% from its all-time high. It's knocking on the door. And that's, I think, what frustrates everybody that owns silver is we're looking at the pure nominal price, I guess, and why hasn't it taken off? But and David probably could mention better than anyone that when silver, like in 2011, when that thing moves, it goes vertical.
Like David says, the biggest part of the move comes in the last 10% of the time. But Bob, do you think that this is the start of new highs for the metals, or do most people, are they still waiting to see how this banking crisis that seems to be contained at this point, how this continues to play out?
That's actually, you bring up the best point of all is people are hesitant. They're not people, yes, you've had a lot of buying, but you have a lot of hesitation. You have a lot of worry that, okay, is this going to be whack-a-mole all over again? Am I going to buy the metals and then get a 2x4 upside my head after I buy it? And I think that's a healthy skepticism that you want to see in the market. We saw that.
And I think it's interesting too, because of that recency bias that we've had for so long. Really the last time we saw anything major like this, systemic like this, was 2008.
Right. Well, and you've just seen, it's funny because you've taken out a lot of the, maybe the froth of the market with, like we had the spaces with Wall Street Silver, for example. You've seen some of these players out there get grounded, I guess you could say, and the market is working off of some of that excess, I guess you could say, and that's part of this growing bull market. It's hard to stay on a bull market. It will do its best to buck you off. And what I kind of see right here is that the market's underpriced or underpositioned on the managed money side. You have very tight supplies on the COMEX right now. What was it, 37 million ounces or so, I think, on the COMEX registered category. And you're not seeing metal coming onto the exchange. You saw it a couple of weeks ago when you had about 6 or 7 million ounces come onto the exchange. And I think from what I was told, that was the U.S. Mint putting that metal back onto the exchange because it just wasn't, because Sunshine could not make the blanks that were needed to make more eagles. And so they had to do something with that silver. But that's being worked back off again as well. The markets are getting very, very, potentially very tight, and we aren't seeing it yet with backwardation. At the same time, you're not seeing the price. The price hasn't gone ballistic yet. And maybe if the price starts to go higher, that's maybe bring metal back onto the market. People may be selling, but right now, I think everyone that has bought, especially the last 3 years, a lot of people are still underwater because the premiums have been so high the last 3 years. There's no reason to sell. Maybe for the people that have held for the last 12 years or 15 years or so, they said, what, it's finally hit 2,000 again, I'm out. But that's just overhead. That's just basically supply that comes in the market on the physical side, but it doesn't tend to hit the price or the spot price because that spot price is more traded on more of the financial markets and exchanges. And that's why positioning is critical to look at when you look at the managed money side and the speculator side.
Yeah, absolutely. That makes sense, Bob. So do you think that this is like that $2,000 level is just a real psychological level for the market, or is it people that bought at that time that are finally kind of breaking even that are wanting to get out? And do you think that provides some temporary resistance before ultimately going through that.
Yeah.
Level.
These round numbers they're huge. I mean, they're just psychologically, it's always been a battle around any even number, I guess you could say. And 2000 is like probably the mother of all, I guess, round numbers you could probably think of. You tend to see is the more times you attack resistance, the more that resistance becomes more brittle and potentially you can penetrate that. And the longer it takes, I think usually a lot of technicians will tell you that when it does break through, that becomes a much more powerful move. And that's what you try to watch for in the markets in general, whether it's gold or silver or any asset class, stocks, whatever it may be. You're watching for that sort of high level consolidation. And then if it does start to move higher from that, that's a big base that it's breaking out from. And that's being in the financial business for 30 years and watching this kind of stuff. I mean, I think that will draw in people into the market, at least on the people that have stocks and bonds or traditional portfolios, and they say to themselves, okay, maybe I should put 2 or 3% of my portfolio into gold, whatever that may be, and get some exposure there. And that's what you want to see. That's why I'm so, I guess, adamant about the industry not overcharging the consumer with some of these extremely high premiums or jacked up premiums. Keep those down so you can actually give people the sense that they can make money in this asset class rather than trying to make a 25% return just to break even, or 30% return, or 40% return. I mean, it only is going to benefit the industry overall if we do a great job of trying to keep these premiums down. I think the physical market is, and I've been saying this for the last couple of years, the physical market's going to start it's been slowly dominating the price action. Yes, you're going to have the price jump around and be volatile. Yes, February, the market got slammed. But if you look at the CTA positioning and so forth, it was just basically managed money crowd just shorting the crap out of silver and gold. And you could see that in the positioning, even though the traders reports were all delayed for like a month due to some type of cyber hack or something like that. These guys potentially were on the wrong side of the market at the worst possible time. Right? It's the start of a banking crisis. So, you look at what these central banks are doing. Not that central banks move the price of metals. Central bank buying provides confidence that there is demand for the metal. There's reasons to own it, and if these guys are buying it, that helps the psyche of the market develop. Gives people more confidence that maybe has never bought metals before to say, hey, listen, if all these central banks are buying it, maybe I should own some of that too.
Yeah. I mean, I think it's always important to consider what that, quote unquote, smart money is doing and when they're buying, because India, for example, China, for example, they want to be buying when the metal is cheap, and easy thing to be a lot more emotional about when to buy. And kind of, have a knee-jerk reaction. I'm sure you noticed this. I got many DMs in the past couple of days about people just wanting to get metal, but it's mostly, to me, the idea is to have this stuff when it's hated. Buying when other people, what is it? Buying, what's that Warren Buffett saying? Buying when other people are hate it and selling when other people are being greedy.
Yeah. I think you're seeing a lot of these portfolio managers and sort of strategists and so forth. They've been opening up to this idea with gold, especially with the volatility in the bond market, and gold actually holding up pretty much flat on the year last year in front of one of the largest percentage increases in interest rates going back to 1980. These metals have held their ground. I mean, it's not, and then you have on top of that the foreign actors and all the geopolitical events that are going on that are driving. It's a global issue. It's not just simply U.S. centric like it was in 1980. This is something that it's embedded in the system. Issues with the dollar and the debt and all that type of stuff. It's secular in nature. It's not going away tomorrow. And that's what I think people are recognizing. And that's, to me, that's why we own metals and And I'm a big believer in physical because, yes, you can get bucked off this train very easily if you're on leverage and you're playing the futures market, or you're stuck in a mining stock and they happen to have a bad quarter, or maybe they didn't hit the strike of metal that they thought they were going to do, or whatever it may be. I think the play is in the physical, because it's at least therefore owning it in cash, basically, where you don't have to worry about the volatility. It's time in the market. You're just waiting this thing out for this thing to eventually play out.
That was actually something I wanted to ask you, Bob. And that was, if you think that with this rise in interest rates, if we're going to see this keep catching up to all these other financial institutions. I know we called this trouble in the metals, new risk landscape, along with some of these digital programs. But it seems like this is a wrecking ball. This rate hike is a wrecking ball that is continuing to wreak havoc within all of these financial markets. So is that something that you see as a risk that is continuing down the road?
Right. You're seeing basically de-risking that's going on, deleveraging that's happening. I mean, that's one of the things when you see interest rates rising, those rates are becoming more competitive for capital, and that capital's coming out of riskier assets or assets that don't pay any type of yield, or that have maybe more counterparty risk, some type of risk associated with it, that people say, you know what, maybe it's easier just to go into a 6-month T-bill, wait this thing out and earn 4.5% or 4.75% or 5%, whatever the number may be. And, and I don't have to take any risk, and I don't have to feel like I'm living in a washing machine with my portfolio. That's a big psyche change, and always that's one of the reasons why when interest rates rise, you have to be very cognizant of that with your portfolio, because not only does your bond side of your portfolio get whacked because it acts inversely with interest rates, just basically the positioning of the S&P 500 relative valuation, and you look at the dividend yield and all that type of stuff, it starts to see more competition and with that higher rate. And then, of course, you have the problem again with the Treasury getting ready to come off the debt ceiling limit if Congress allows that, probably by June. Where's all this money going to come from to support new issuance? And yes, there's $2 trillion sitting in the reverse repurchase program, but most of that, 90% of that money is money market accounts. And you have to ask yourself, why are they all stuck in the Fed's reverse repurchase program rather than not just throwing it into the market and potentially maybe earning a little bit higher yield? Well, liquidity, it's safety. I mean, it's the ability to say, listen, if I need money, I just go to the Fed, they cash me out in a heartbeat. This is part of the psyche that's building in the market, and it's like a crescendo. And until we have that event that ultimately everything hits the fan, I think that's the stress that we're kind of feeling. I'm sure, like O'Hara would probably mention, and David would probably mention, there's when you've been in the business as long as we have, things don't happen on a dime. It takes time for these things, these processes to develop, and the psyche to build and to wear people out. It's one of the reasons why it's like the market can stay crazier than you can stay solvent if you're trying to fight the market. It's just the way the psyche of crowds work, I guess you could say. But when everything starts to fall apart, it happens really fast. And what's interesting is, now the SEC is going after, all these crypto influencers and celebrities, and you're seeing this crackdown across the board that is just another symptom of the SEC is at some point maybe trying to sort of maybe make it look like they actually care, I guess you could say, because they should have came in a long time ago with some of this stuff. But that's
explain that list that you tweeted earlier, Bob, and what that was, to do with. You just mentioned all these celebrities, so explain that a little bit more.
Yeah, that was celebrities that were paid, I guess, to promote different cryptos and didn't disclose their compensation, I guess you could say. The problem with the crypto market is that these things are being deemed as securities in a lot of cases, and there is a lot of regulation when it comes to selling securities in the marketplace, especially if they're private offerings or if they're Reg D offerings where they can't be sold to the general public, but it's they're sold to accredited investors or supposed to be sold to accredited investors. Well, when you have a lot of these celebrities out there that are being paid endorsements to promote a token or whatever it may be. And obviously we've seen, the zoo that we've seen in token land when it comes to all these prices flying all over the place. Now that these things have all blown up, people have lost a lot of money. So there's a public is there with their pitchforks, wanting some type of retribution, I guess you could say. And, a lot of these celebrities that are worth a lot of money, these guys have become sort of target number one by the government.
Yeah, that makes total sense, Bob. And it's kind of funny to me that the SEC is now coming in to try and get a handle on this. But do you think that is because it took them this long to figure all this stuff out because it was such a new thing? Like, do you have any idea why it might be that it's taken this long for them to start to crack down on it?
Well, sure. It doesn't take a rocket science to figure out that probably a lot of pockets were lined the last 3 years, 4 years, whatever it may be. A lot of grease was probably laid out there. And then the problem we run into is, we're just common people. We don't see the inside of Silicon Valley and how that works. There's a lot of these guys that you hear about spaces and that start to uncover some of this stuff. And on Twitter, that when you start digging in here, and a lot of these guys that are worth a lot of money, you realize some of them are just selling Ponzi schemes. I mean, some of it's just pump and dump. There was no real true value in some of this stuff, and some of these these private offerings and things like that. They rode the wave of the market, and a lot of people, some of these guys got really rich doing it. But I think that's, if you want to look back, well, I guess we look back in history, we look back in the 2020 timeframe. I mean, the cryptos is probably the epitome of speculation. I mean, buying something that literally is just nothing. Or the NFT market with all this art, or there was an article was a couple of years ago, where a guy sold a sculpture that was basically just airs, an invisible art piece for like $15,000. I mean, it was just, money was just sloshing around everywhere. It had nowhere to go, and so it played the casino basically, and that's a problem. When that money's lost, it's not coming back, and it ends up hitting risk taking, and ultimately people that run small businesses and so forth. I mean, that do a lot of employment. All that stuff has trickle down effects where their portfolios now get hit. Maybe they can't take the risk, they can't expand the business. But what you haven't seen yet, which is usually the employment side, which is usually a lagging. It's not a leading number, but it's more of a lagging thing. Is what happens if we go into a recession? Maybe a deeper recession where employment starts to a little bit, and all of a sudden people start to say, well, wait a second, I can't pay my mortgage or my rent anymore, and there's no more moratoriums. The government's not forgiving those loans or allowing me to take a year off from paying any of the stuff. I mean, this is where I think the younger generation is going to feel a real pinch, and I would hate to see that happen.
Yeah, that's a great point, Bob, and it's just a matter of this entire thing catching up with itself. And Reggie, you just asked to speak here, but I'd like you to give us your take on this stuff as well.
Okay. First, just want to push back on what Bob was saying, because it sounds like, and I want him to clarify, if you don't mind, that you are accepting the SEC's proclamations as fact. Am I correct?
Yeah, I mean, some of these things that they're going after were basically Reg D. They were either Reg D offerings, or they're deemed as a security by the SEC, or at least that's their opinion, that they should have been treated as a security. And of course, that's right. That's just being in the business as long as I have. I mean, some of this stuff, it meets the test, the Howey test. I mean, it meets some of these tests that people look at, or just the way that they're sold to the public. I mean, whether it's a token or anything, there should be some disclosure if you're being paid to promote something.
Reggie, if I could just interrupt for 1 second, why did you ask Bob that question? Is the SEC taking this, or is he taking this as fact? Just give us your standpoint there.
Oh, because I just wanted to know. I don't want to mischaracterize what he's saying. So, okay. I'm about to address it, but I don't want to say he said A when he said B. So From my perspective, in a legal dispute, the plaintiff's opinion is far from fact. It's simply an allegation. And if you rely on an allegation, that's hearsay. So in order for, let's say, KV token to be considered a security legally, it has to be proven so in a court of law. If I allege that KVT is a security, does that mean that it's a security and it should have had a Reg D offering? Or is that an allegation by a plaintiff, by definition, an adverse party? So a plaintiff in a dispute is not going to say things that you like or that you want because they're an adverse party. The conversation to begin with, for that perspective, I think is off from a factual perspective. As for Howie, with a little ingenuity and imagination, you can make almost anything fit Howie. Almost anything. Tell me about your business. Do you sell? What do you sell? Let's walk through this as an exercise.
Sure. Yeah. I mean, I run a hedge fund, so I'm familiar with the Reg D offering and that type of thing. So you have to be very careful, not publicly advertising.
Okay, but before you go, I just want to know what you sell. So is the hedge fund your only business?
No, buy and sell metals as well. So we just do metals in terms of physical metals paid for in cash. So there's no leverage, there's no forwards, there's no.
Do you store the metals?
Yeah, and we store. Yeah.
Okay. Do the metals, when you store the metals, do you give a receipt for the metals that you store?
Correct. Yeah. What we do here is everything's fully segregated in terms of the holdings, so everything's separately identifiable. There's no commingling of assets, and provide a inventory report or certificate, I guess is what you could call it, that allows for full delivery.
Okay. Do these metals have a capital gain of any over time?
In terms of, I guess from a standpoint of...
Do they go up in price?
Yeah.
Do they go up in price?
Yeah.
Okay. So, and when they go up in price, do you return the metals if requested?
If the client wants to take delivery, we can ship it out to them. If the client wants to sell it, they can sell through us or sell through somebody else.
Okay. Now, is there any indication or any of your marketing that the metals have went up the price in the past?
In terms of Idaho Armored Vaults doesn't provide any type of investment advice or...
No. Okay. You're hedging the answer. My answer is there any indication that the metals have went up in price in your marketing material on your website? It's like a binary yes or no. So.
Yeah. I don't believe it's really advertising in terms of price action.
Okay, but Bob, it sounds like you're trying to avoid the answer. Is there any indication that the metals have went up in price on your website or marketing materials?
Well,
humor me, yes or no? Just humor me.
Yeah, I guess you could say there is advertising where it comes to how metals have acted in prior, like risk events, that type of thing. Yeah.
Okay, so I'm not picking on you. I'm trying to show you how thin the line that you're walking is.
Sure.
According to Howie, I can make a strong argument you're selling securities. Not the metals are not securities, but you have sold securities in the manner that you sold them. I walked you through a hypothetical, okay? And I'm trying to get you to see the danger of taking an adverse party's opinion as fact. Very dangerous. If you've ever had a divorce or been to family court or watched it, you can't take what one party says about their spouse when they're in a fight as fact. Okay. So, Bob, I'm not picking on you. I'm walking you through, how flexible Howie can be depending on what side of the fence you stand on. Okay. And B, more importantly, because an adverse party said something doesn't mean it's true. According to the current chairman of the SEC, all crypto that he knows of are securities except for Bitcoin. That would include everything that Kinesis sells. It's crypto. It's running on a popular chain or a fork of a chain. Have you ever discussed or recommended Kinesis? Because if you did, you sold securities and you're in the exact same position as all these other celebrities that you're talking about. Hypothetical, but this hypothetical is backed by the words of the chairman of the SEC. Be very, very careful what you say. I'll land my plane there, but I'll gladly have a discussion if you want.
Sure. No, I appreciate it. Thank you, Reggie. I've never recommended Kinesis. I've stayed away from the crypto type of world, I guess you could say, or the digital asset world from a standpoint of recommendations and so forth. It's interesting that you mentioned with physical metals, there actually is law in the United States when you're dealing with physical metals paid for in cash and making delivery within 28 days. Those are actually, it's a commodity that's not regulated by the CFTC or the SEC. It's regulated more on the state level under the commodity codes of those particular states. So
I want to jump in. I don't mean to interrupt, but I don't want to go too long. That's not true as I articulated. I told you that metal wasn't a security. The fashion in which you sold it was an investment contract. That's why I asked. Hold on. Wait. This is a hypothetical argument for us to stretch our brain cells, get the synapses firing.
Sure.
Okay. Just like the Orange Grove scenario. The oranges weren't the security. It's the matter in which they were marketed. But I have what I believe was the first redeemable tokenized gold program in history. I believe the SEC came after me with all types of nasty allegations. They had my client's gold in their jaws and they had to let it go. Or they did let it go. I'm presuming they let it go because they couldn't make the security argument. But I'm presuming, I don't know, but I'm pretty sure because they're rather aggressive. But the argument can be made if I was a junior layman prosecutor. From what you explained to me, I can make the argument that even though your precious metals were securities, you had an investment contract in the way you sold it. And yes, there is an exemption, okay, for things that were purchased in cash that don't use leverage with a delivery date below XYZ. But if you sell it in a certain way, you still have an investment contract. You have to be very, very careful. And I don't want to debate the law. What I'm debating is because the SEC said it, that means it's a security. Right. That's a slippery slope and very dangerous. Go ahead.
So you bring up a great point, investment contract. And so when you're selling metals, if you're doing it as a investment contract, that's like a pooled program or a balance sheet financing operation, or you're investing in a bar as a portion of that bar and not actually having to take delivery of that bar. You're just saying, let's say you buy 1,000-ounce silver bar, or you're investing in 1,000-ounce silver bar. You buy 39 ounces, and so the sponsor holds that 1,000-ounce bar in a vault somewhere. You can't actually take delivery of that portion of a 1,000-ounce bar. That's actually an investment contract. Buying metals in physical form in cash held segregate or on a segregated basis that's fully identifiable to the client. Delivery has been made to the client. That's actually not an investment contract. That's actually under the commodity code. And that actually is the law.
I can guarantee you, I can make a critical. If you say, I'm selling gold for cash and you will make X amount, or gold has one of X amount, and I expect you to make that, you've just made it. You just sold the security. See, what you're saying, as you say it, but there's a lot more fine print nuance that goes to it. All you have to do is create an expectation of return, and then you can have an aggressive prosecutor come after you. Put it this way, they have a credible enough argument to break you with your legal fees.
Well, it's not that they come after you from a standpoint of selling a security. The question then is, how are you selling that? Is it being sold surreptitiously, or being where it may be sold fraudulently, or could be sold with some type of malpractice type of situation where you're taking advantage of somebody, but that's not necessarily an investment contract. That's just paying overpriced for. It's great to hear both sides of the argument. I'm all for it. The problem we're running into, though, is the public ends up getting caught up in this whole thing in terms of buying assets and watching price action and being sort of lured into this idea that some of the stuff was going to the moon and staying there. And if it was built on a foundation of basically quicksand, I think the problem is the SEC is kind of recognizing after the fact, like most regulators do, where the problems lied, and now they know actually how to go after these people. Whereas while all this was kind of taking place, there's only so many regulators out there, compared to how many different tokens that were being created every single day. And that's the tough thing about these markets. That's why, when you've been in the business a long time, and just like Reggie was mentioning, and he's made some great calls. I mean, Reggie's done really well, especially in 2008. I was watching his work back then. He did tremendous work on the banks and so forth. He's very knowledgeable about the balance sheets and so forth, but a lot of people aren't. And a lot of people just listen to influencers or promoters or other people thinking, okay, well, if they're doing it and they're making a lot of money, or they're rich and famous, maybe I should take a dabble in that too without really doing much homework, or maybe they don't have the skill set to analyze a balance sheet or to look at a token, or a lot of these tokens probably didn't even do a full financial audit and provide that audit to potential investors. And that's one of the things that I try to promote, is the idea of understanding these user agreements and documents, and try to understand how they're written. If they're written one-sided, why are they written one-sided? Who do they actually protect? And that's part of the problem in the physical world of commodities. In terms of physical metal, there is a big difference between an investment contract and just buying gold or silver and storing it. You're not buying a physical commodity. It's not dependent upon my business for that commodity to go up in price. That commodity is traded on a worldwide basis, and it's going to do whatever it does. And we try to do as investors is try to look into the future and say, is gold going to do well, or if it's not going to do well? And if it does do well, it usually does well during times of crisis or uncertainty or inflation or political instability or social policies or tax policies. Or that's why we buy the metal. And it's not dependent just because we go out and buy a gold eagle that the price of metals are going to go up. Now, if you set up a program that is a pooled investment program that basically takes your money, and I call it a balance sheet financing operation, where you create a program that takes your money, goes out, buys 1,000-ounce bar, takes that 1,000-ounce bar, refines it into 1-ounce rounds, sells those rounds for a fat profit, and goes back out and buys another 1,000-ounce bar. And I'm using your money to do that with this expectation that you have some type of silver credit that you could then redeem at any point in time in the future. That is an investment contract. You do not own the actual physical metal in bailment form. You own either a credit, or you own some type of promise to be paid either a credit or some type of physical ounce, or redeemed for some type of other product that you have to pay a premium in addition to. This is stuff that I've been mentioning for the last 10, 15 years, especially with the Perth Mint program. I've been talking about that since 2009, how that is a balance sheet financing program. It's using people's money without paying them any interest to go out and finance their operations for refining and so forth. There's a lot of programs that do that. There's a lot of programs that have come up in the last 3-4 years because of blockchain and digital and all that kind of stuff that sounds great on paper, but there's a lot of concern there. You haven't seen the concern in some of these instances because the prices keep going higher. But when the prices start to stagnate or activity starts to stagnate, then you start to see some of these programs die off. And the problem is people that are stuck in some of these investment contracts, I guess you could say, or securities or structured programs, that there is no exit strategy except for the program that provides its own liquidity. If they can't get out of it, they're screwed. The whole idea is look at the user agreement, and it tells you all you need to know. If that user agreement is saying, listen, in the last clause of the paragraph under limits of liability, it says you're not going to get your money back. You don't have anyone to cry to. If you take them to court and the lawyer for the other side, it says, Mr. and Mrs. Client, did you read this clause here? It says, you don't have any recourse whatsoever. That's life. But at least try to understand what you're investing in. That's a lot different situation than buying a piece of metal and storing it in your home or at a depository.
Yeah, and I think that's the biggest point of what we're trying to share here, Bob. And you and I have gone over this ad nauseum of the risks of, just trying to highlight these risks, not necessarily bashing any particular program, one or the other. As Palisades, we try to be completely neutral within the industry. I have done my best to, if there was allegations brought against anybody, to give them, the other side, their chance to speak. And it's just the point of trying to, bring this to people's attention that might not have understood it when they entered that program from the user agreement standpoint.
Sure. In the metals world, there's a lot of good dealers out there. There's a lot of good guys that promote a lot of real great information. Nothing to bash anybody, and don't really like doing that. But the idea that a digital program is better than just simply buying the metal, because you can have the convenience of buying, a cup of coffee or using it on the fly, basically with a debit card. What they have to ask themselves is, do they understand the mechanics of a digital program? Yes, there's metal sitting in a vault somewhere, and it's backing that program. You still, if you're running a debit card, you still have to, if you go out and buy that cup of coffee, there has to be some payment method that pays that merchant right away. So there has to be some reserve set somewhere by the sponsor, some type of cash position somewhere that can make the payment to the merchant immediately before they even sell the gold. Otherwise, this idea that that's your gold that's sitting in the vault that's backed by your token, in reality, you'd have to sell the gold first before you could buy the cup of coffee. So the digital program actually incorporates more counterparty risk than it actually solves. It's convenience, but you're actually paying for that convenience. That's why they have all these fees and so forth. Whereas if you just buy the metal and you want to go out and spend the money, sell the metal, put some money in your checking account, and then go out and use your debit card from that. I mean, whether, not saying either way is right or wrong, but just understand the mechanics of how a program works and then all the moving parts that are involved with that and what can go wrong if something does happen. I mean, if like these digital programs, if you had 15,000 accounts and they all had maybe a couple $1,000 balance, and all of a sudden they all went out tomorrow and said, you know what, I'm going to buy myself a TV set for $1,000. Yeah. And they basically spend down half their account. How does the digital program react to that? Or does it have the reserves on hand to match half the position of their entire holdings that they can dump out and sell and provide it to the merchant within a moment's notice? I mean, those are the things that you have to think about.
Hey, could I comment?
Sure.
Okay, so I'm going to push back against you 2 more times, Bob. So first, in terms of protecting the public, okay, in just the last 2 weeks, I'd say a minimum of $250 billion was wiped out of investors' pockets. It was a very obvious problem that was very easy to see coming. Let's assume it was hard to see coming. I warned everybody for the last 2 years, okay? Silicon Valley Bank, Signature Bank, I forget the other S name, 3 S name banks, and Credit Suisse. Silvergate, right. And Credit Suisse. Credit Suisse has $17 billion of bondholder value wiped clean to zero almost instantaneously. Now, compare that to all crypto losses. I'm pretty sure that outstrips all the losses anybody took in crypto. Why hasn't SEC went after those banks? And let's assume they just couldn't figure it out. Well, there's at least 180 other banks with the same asset liability mismatch problem. SEC has a perfect opportunity to go after them now. I don't see any of them with Wells notices. I don't see any of them in court. The attention is being given to the crypto companies, primarily, despite the fact much less exposure, much less loss. And it affects the risk to the common person is much, much, much smaller. So you're talking as if crypto in general is bad compared to the traditional sector, but the math disagrees with you by a large margin. Now, if you take a look at the banks that were seized or closed down, these were all fintech banks. They all had APIs. More than half of them allowed 24-hour payment systems because of their technology. Why were they closed down? Their problems don't differ from anybody else's. And I'm not going to name particular banks, but they're big multi-trillion-dollar asset banks in terms of balance sheet size. Exact same problem, right? They have more liquidity, but from a relative perspective, they don't. The problem is the same. So again, why aren't they taken out? The regulators are targeting the new boys on the block. And if you don't believe so, I simply ask you to show me. Why not? Now, and second, in terms of you saying that there's more counterparty risk in the digital gold space than the traditional gold space, is put together properly, because I can't speak for everybody, I disagree with you. If you sell somebody gold and then you store it and you give them a paper receipt or send them an email as a receipt, that's the same thing. Same mailing certificate, just different format. Either centralized electronic, decentralized electronic, or physical paper. It's the same thing. The advantage is with a digital certificate, especially a decentralized digital certificate, you have liquidity. You have the visibility. And you have a guaranteed, almost impossible to violate provenance chain, basically built-in ordering. Ernst & Young in the box. So I push back on that as well. But I'm going to land my plane so nobody says I'm talking too long.
No, I appreciate it. Well, if you look at the token space, for example, and you look at digital gold, for example, if you have divisibility, it's impossible to have bailment, because if you have say for example, a 1 ounce gold bar and you sell 1 gram of that 1 ounce gold bar, ultimately the sponsor who has that metal has to sell that bar, so to speak, cough up that 1 gram of gold. So therefore you've just changed the entire, unless you've melted that gold down and taken 31 extra grams, made that from that original 1 ounce gold bar. When you change the form, it's a different piece of metal altogether, and that becomes a sale. That's not bailment. This is court cases that stem from Republic Metals when they went under, because there is U.S. court precedence with this. But this is part of the issue with making full delivery to a customer and then storing that metal on their behalf, where they actually control that metal. It's not controlled by the sponsor or dealer. It's not considered a financial account, so to speak. The issue you run into with digital metals is that ultimately, let's just say they have just a bunch of 1,000-ounce silver bars, and that's what they're using as collateral, or that's what they're using to anchor those tokens. At some point, if they're buying and selling these bars and changing the bars, and your token's not associated with that bar anymore, you don't have that. Also removes that sort of bailment. And at that point, you really don't have a specific piece of metal tied to that token. You just have what they call either a pooled or some type of allocated type program. So you don't have actually real delivery being made to the client. So then therefore it turns into an investment contract, and an investment contract turns into a security. And that's part of the reason why some of these programs stay outside the United States, because if they did try to come into the United States, they would meet the regulatory oversight of either the SEC if it's a security, or if it's a swap or some type of futures contract or forward contract, it would come under the purview of the CFTC. There's reasons why we have all these laws, and they stem back from the 1920s. I mean, after the collapse of 29 and so forth, and the Securities Act of 33 and 34 and all that other stuff. There's reasons why we do some of this stuff. I'm not saying it's perfect. I totally agree with you, Reggie, that a lot of the big boys get slaps on the hand when the small guy gets basically carted off, into oblivion. That happens, and it's regretful, and I hate to see that, because promotes only more moral hazard amongst the bigger players that can take the risk because they know that it's just the cost of doing business. That's unfortunate. I even see it in my role as an investment advisor. You see some of the stuff that big boys get away with, and it's just, to them it's a fine, but it is the cost of doing business. They don't go to jail. They don't lose their livelihood or reputation. Life keeps going on for them, and that's a shame.
City, you've been patient with your hand up here. I'll let you weigh in. Please keep it respectful.
Yeah, I mean, essentially, there's exemptions for all forms of dealing and markups and all that, right? But there's one exemption that is out there, and it's for fraud. There is no exemption for fraud. So you can sell bubble gum on the street. If the SEC came down, someone had to have fallen. And, I think when I hear a lot of crypto, I seen a chart. There's 21 trillion in gold. You know who buys gold? Central banks. If gold has been traded for 5,000 years, going all the way back to the Roman times, that's the most steadfast chart that's been out there. So, a question that I've posed in a lot of different spaces is that if central banks were smart and they're holding a lot of the concentration of gold, they might as well monetize the derivatives market instead of booming and busting the economy every which way. Now, as far as crypto, I think at its peak, it was 3 trillion, 3.5 trillion. I don't remember, but that's a fraction of the gold's entirety as far as the market. And they're still mining and making discoveries. So These crypto, DeFi, and all these other bozos, they can't even buy a Fortinet firewall for their APIs, and they don't even have APIs. They're doing all traditional technology that banks have a tremendous amount of regulation already in place. That's why there's companies like FizServe that handles a lot of the back office for these financial services company, because there has to be records for many, many years, not just a digital footprint that disappears when they do tornado cash and these DeFi rug pulls. And it's just not a reputable space to be in. So, when a lot of people are defending crypto, the SEC comes after those that have lost money, and it's significant enough that they get a securities lawyer to get involved to do a formal investigation. That's why you see the DOJ go after so many of these pump and dump schemes, even on the equity side. So again, my point is there's no exemption for fraud. It doesn't matter what you're buying or selling.
Yeah, and that's a great point, because that's part of the reason why these Reg D offerings exist, is that they're aimed to accredited investors. Not that accredited investors are entirely sophisticated and smart. They're just presumed to be maybe a little bit more sophisticated than the general public, and that's why laws are in place. But I agree with you. I mean, you see some of this stuff, and it's like, where's your full financial audit? How does your business actually run? Where's your organizational structure? And then the problem you run into is like FTX or some of these other things. They're just Ponzi schemes. I mean, it's just massive pump and dump, and you're running a business offshore and you're wondering why they're not onshore. I mean, there's reasons for it. That's all I got to say.
Yeah, like FTX, right? FTX, here you have an MIT grad. You think it was intentional that he was down in the Caribbean operating, on foreign soil, thinking that there wasn't going to be any clawback, or that, the SEC and the DOJ can't go after him? Come on. Once you do business with a United States citizen, you're not immune to extradition to the laws. The laws of the land don't transcend maritime law. Jurisdiction is going to fall where either party it resides, not where the host of the criminal action took place. So, there's a lot more to it. But I mean, these people that defend this, where did all the crypto money go? $3 trillion. What is it now, under like 800 billion, with Bitcoin covering, nearly half of that market cap? I don't know, man. I mean, I listen to you guys, and, this is why nobody wants to talk with you guys, because, it's not a proven technology in the sense that central banks are not adopting it. They control and dominate every country that they reside in. And to think that y'all are going to go after them, it's just like what Marcus Lemonis says. It'll squash you like a little bug.
Well put there, Storm City. I appreciate you weighing in and your standpoint there. David Morgan, I believe you're able to join us now and share with us kind of your thoughts on how you see the markets right now.
Okay, let me just state that I'm on a phone and I live in a wooded area. So if the audio is bad, Tom, just let me know and,
sounds good so far, David.
Okay. So first I'll just start with Reggie and give him accolades. I mean, human, all of us have our ups and downs, but he's made some awesome calls. There's no doubt about that. And you can verify every one of them. And I did an interview with him some time ago, but it was probably one of the most articulate, spot-on interviews. Got a lot of compliments. But I'm going to move into the metals, something I know a little bit more about. So going back to the beginning of the discussion, Bob made a couple of points I wanted to emphasize. One is, where are we? And the answer of a bull market is climbing that wall of worry. And this is where we are. I think, obviously, there's been a lot of move into gold. I said personally that I see the run to gold has started. Can I prove that? Of course not. I have some evidence, because the amount of gold bought by the central banks last year was significant relative to other years. So that's sort of adds to my point, but is that absolute proof? No, it's circumstantial. And then where are we going to go with gold in the 2000 barrier? Bob's right. I think all of us would agree pretty much that have been in this market for a while, that round numbers seem to have some magnet around them. It's really hard to penetrate them. And then once it's penetrated, that resistance becomes support. And once the support is in the new number, then you're looking for the next round number. And that's just a generalization that's vague and it's not here to all the way up or all the way down. The point I want to make is, where are we in gold? And the point is, now I may have the numbers off and I don't need to be picked on, but the last time I just did a real quick search 2 days ago, and what was the all-time high price in gold by year? And in 2020, it said 2058. I imagine that was the spot market, not the near futures, but I don't know. And if that's the exact price or not, I don't know. What I do know is this. Once we get above the all-time high, and remember, it's a nominal high. Remember that 2068 is not nearly as much value today as 850 was January 21st, 1980. I think we all know that, but I just want to make the point. So the nominal high, once it's exceeded, you're going to see a bunch of algorithms come in. And there's a reason for that. When we're talking about support and resistance, there is no resistance once you're at a new high. Everyone that owns it at a profit. And the tendency of humans is to hold it because they don't know how high is high. So a little bit of buying will take it higher, and a little bit more buying will take it higher. And that's how you get these parabolic moves. And that's what happens, especially in silver. Going back to the silver side of what Bob was saying is that, I coined the phrase, silver will scare you out or wear you out. And I was asked several years ago, probably a little sharper than I am now, but regardless, to write an article on silver. So I did, of course, and I called it Spiked. And the reason I called it Spiked is because silver has propensity to spike high and spike low. In fact, some of my best trades I ever did were on a spike low, and not to brag because I purchased silver at the wrong times. But when we saw that spike in March 2020, when the gold silver ratio got to roughly 125, luckily I had a lot of cash on hand and made a purchase right within a couple of days of that bottom, because I know the market. I saw a spike. I know I didn't have to sit there and contemplate it for a week and a half, because if I did, I would have missed the opportunity. Longer term, I've been a metals bull almost my entire life. There's reasons to be in the metals. Most people that get involved either don't do it correctly because they leverage, or they buy the wrong thing, or buy at the wrong time. And it is a hedge position the way I look at it. That means that it's like a good meal. You don't want to go overboard in any one part of the meal. I mean, if you do, you might, have indigestion. So this is the one, I say, point that I get more and more over the years is, I wish I would have listened to you sooner. And believe me, I've made plenty of mistakes, but the idea is, what's the right amount for you? For some people, I talked to my friend Mike Maloney. For Mike, what's the right thing? Not counting his real estate and his cars. He's got almost everything in metals, but he also has real estate and cars. So anyway, but that's Mike, and that's what makes Mike happy. He's single, he doesn't have a family. There's a different dynamic. So metals are important in crisis situation or monetary uncertainty. And I don't think there's anyone on this call that wouldn't, or the spaces that wouldn't agree with me that what myself and many others have predicted for so long, we have a debt-based monetary system that's leveraged to the hilt, that something's got to give sooner or later. We're going to have a banking problem, and this is what we have. And I'll just add on, I don't, I think Reggie could outthink and outspeak me, and I certainly don't want to have any pushback from him, but if there is, there is. But I could make a case, and I could take either side, but I certainly would have a stronger case on it. Certainly appears to be that the crypto world has been singled out here. And I think, this is just my opinion, the reason for it is that, as I've said in many of my interviews and what I've written in my personal financial newsletter, is that the banks look like they want the next reset to go to their control. They don't want to lose control, and they want the CBDC. And the best way to do it, in my opinion, is to make all crypto bad. There's no good, not regulators, securities, not securities, and all that. And then they come out and say, but we have a solution. And the solution is the bank regulations are such and such, and therefore our cryptocurrency, our central bank digital currency is the way to go. So I'm going to pause there. Tom, thanks for letting me have the floor, and I'll hand it back to you.
Thanks for weighing in there, David. Anybody have anything to add to that? Go ahead, Reggie.
Oh, okay. How you doing, Dave? So I'm not as good as the metals as everybody else. I just, follow numbers. But gold is the negative correlation between gold and real rates is rather strong. And negative real rates are here, and they're going to be here for a while because you can't push them up. If they do, then the asset liability mismatch of all these banks goes boom. They're going boom without real rates going very high. It's a matter of fact. I think real rates might still be negative. I haven't checked in a while. But also, Dave is right. But if Dave is right, then the guy that spoke before him is wrong, saying that central banks haven't adopted crypto. Every major central bank has a crypto program running. CBDC is a crypto, and period. That's it. And so the technology is here. You can discriminate against it. You can not like it. I understand. A lot of people didn't like the internet back in the early and mid 1990s. A lot of people didn't like cellular technology. A lot of people in the mid 80s. A lot of people didn't like microcomputers when they came out. But not liking it is not the same as it not taking over. And it's here to stay. Once CBDCs are adopted, the crypto is going to be into everything. All the exchanges are taking over are using distributed ledger technology. So if you're going to trade stocks or commodities through a large exchange, you're going to be using crypto. If you're going to use any fiat currency in digital form, you're going to be using crypto. It's a fact, okay? The discrimination, in my opinion, and I agree with Dave, is that the regulators are wiping the entrepreneurs off the map so the extant financial legacy system can take over. From a cultural perspective, they would never be able to build it because the people who build it don't fit into the banking culture. And those who are in the banking culture who figure it out tend to leave very quickly. Because a lot of the successes, or I guess you could say successes in the crypto community, are ex-bankers. Look at the CEO of Coleman. I could run down the list, but hopefully you get the message. And then the balance of the successors were never in the financial industry because it's matching the culture. So I'll land my plane there since I was told I was long-winded, but I'm also cooking a steak, so I have a couple of minutes to spare.
Thanks for that, Reggie. That's a good point about the culture. And I think that's an interesting point to consider about how these systems get implemented and by whom. Jaime Carrasco, appreciate you joining us. Do you have anything you'd like to add here? It's been a while since we've spoken.
Yes.
Thank you.
Thank you for having me on. Thank you for inviting me to speak. Yeah, I think it's important to understand that I, for one, have always liked gold, silver, and blockchain because I see them running in tandem. I think gold and silver are about the past and cleaning up the monetary imbalances that we have created. To me, blockchain has always been electronic currency. And the beauty of electronic currency is that it takes the banking system out of the equation because the centralized power of the banking system is defaulted by the electronic benefit of having a decentralized system to manage things going forward, which means why do we need an intermediary? But what's important is that if you look at what the BRICS are doing, what Asia is doing, we're seeing the rise of the new system in the same way that the U.S. was being born, or the U.S. dollar backed by gold in the early 30s, right? But what's interesting is that once again they're going to use gold because gold is needed as a peg for their trade, for their balance of payment. But they also understand that blockchain going forward is going to be used as for the decentralized settlement of trade. And so to me, it's amazing because we will have a decentralized world that is being born, but gold and silver are going to be part of that peg. Now, I don't dismiss the social consequences of what's coming from the unraveling of this debt bubble and the mess that they've left us in. But by the same token, I don't think we'll ever forget why we didn't want a centralized system. But the rebuilding will be fascinating. So, I go back to what I've always said about the way that the Chinese write the word for danger, crisis and opportunity. I think it's important going forward for individual investors. First of all, is what's your allocation? How much do you have in gold, silver, and blockchain? I know that I'm very happy with the way my investments are finally performing, but it's been a patient wait to hold on to things that nobody owns. Right. The main benefit for us and I bet you most in this listening tonight, is that we've held steadfast to our holdings, and now we can seek the rewards that come next. But we're half of 1% allocation of Western investors. Why is that? Because, go back to the Great Gatsby and what Fitzgerald was talking about, the roaring 20s and the chase for prices, not for value. And one of the reasons why people don't own gold is because the price has been kept from inflating by banking policies of selling forward shorts of physical production that they don't control. But here we are, the Asia is taking the physical away at the same time, and they're going to start using it as gold again, as money for their trade. So I think that most on this call, I salute you for having held on and be patiently waiting for things to take off. But we are watching the unraveling of the past.
I mean, do you think that the only reason that we're going to, let's say, as you said, get over that 0.5% as Western investors is just because of the price action that, is coming? Or is this something that people have been kind of watching and they're only going to jump in on based on momentum?
Most definitely. I think Patrick, who's listening here, I think he would attest to that. And we're seeing it on a technical perspective. Charles Nenner's looking at it from a psycho perspective. It's sheer greed now that, once the Titanic began to sink, people realize how dear those lifeboats were. And that's where we are from a financial perspective, is that as we see more and more money filter out of the markets, both bond market and the stock market, there's only one place that it's going to go. It's not going to go to the dollar because the world is walking away from the dollar. And what are they going to use? They need something that they can peg. It's amazing, the setup. Everything we've been talking about for the last couple of years is here. We can see it. There's no more guessing, right? And that was the one thing I said. It wasn't about if, it was about when. And I think it's here. Look at what they're trying to do right now. That the Credit Suisse, it's gone now, but a company that lost $7 billion last year is asking the Swiss central bank, who lost $150 billion last year, for a $50 billion loan, and they threw UBS in the system. Well, UBS has a huge short position on gold, right? And that short position is also going to hurt them. So, trying to keep a system together that's no longer working.
David, go ahead. You had your hand up here.
Yeah, I just wanted to add on to it that I did an interview with Mike Maloney recently, and he's written a new book on gold and silver, and he makes some very important points in my view, and that is availability for people to buy gold either physically or digitally is immense relative to what it was in the 1979, 1980 run-up, and I was in that. And, of course, there's some, I might call it dilution because the ETFs didn't exist back then and that type of thing, but you've got a world out there that can buy gold and silver now that didn't exist in the 70s. You have internet and easy access, or a phone, where you can go to a number of different dealers and just buy with a click of a button. So the fact that we have about 0.5% in the market, and no one knows this number. I've heard it. I've heard different numbers. I don't know. Mr. Blanchard was asked years ago, and of course he's deceased and gold bugs know that, but what percentage was the average American invested in gold in the 1970s? And again, I don't think anyone knows the answer, but it varies between 2 and 5%. That's what you generally will hear. So I'm going to just accept that. I'm also going to, critique myself that I don't know. However, that 1% would be a doubling in demand, but it's not a doubling in demand necessarily for a bunch of gold bugs like it was in the 1970s. It's worldwide. And the thing that's worried me the most about this financial crisis, and I've been talking about it for a long time, is that it's not a specific area like the Weimar Republic where you could have gone to Austria, you could have gone to a different currency. A lot of people got hurt, but there was a way out. And this time it's worldwide because the reserve currency is the US dollar. Yes, the BRICS may be able to mitigate it. I'm undecided. I'm still thinking about that. But regardless, if the dollar goes, everything goes. And I forget who spoke before me, but yeah, we're still in negative interest rates. And I don't think we're going to go much higher. I think the Fed is scared, and I think they're powerless at this point. I don't think they have much ammunition left. I think either way they go, the market's going to perceive it as the wrong move. And so I think having the metals position now is more important than any time in my lifetime. And of course, I'm biased. I know what happens from monetary history. I know what suffering could take place. My parents went through the Depression. My grandmother, my dad's mom, and all that. I've got a recording of her and what they had to go through and how hard it was, and on and on and on and on. And we're definitely in a recession. People can argue against me. I don't think that's much of an argument with this crowd. But are we going to go into global depression or not? And I think that remains to be determined. So money isn't going to solve everything, and I refer to money as the precious metals. But currency and printing obviously isn't working anymore. So we are in a position where we really got to think through this logically, clearly, being grounded, and also look at the bigger picture where there's more to life than money. But money does solve a lot of problems, especially when everybody is in a panic mode. So I think I've said my piece. Thank you.
Actually, if I might add something, David, to a point you just said, from my early days at Merrill Lynch in the early 90s, late 80s, Dun & Bradstreet, they did the work, and they calculated that in the late 80s, as per asset allocation for institutions, pension funds at the time sat at about 8%. So that's a number that we're looking at. And right now, if you look at the pension funds, institutions, all the generalist ideas of pushing everybody to the side into these structured products with a lot of counterparty risk, it stands at 0.5%. And nobody understands gold today. So we have big room to go in terms of the ownership. And actually, I was talking about you, and so happy that you're here today, because I was telling them when you were talking about how much some of these stocks moved as that money flooded into the stocks and the type of movements that we saw in the miners. And I think if you compare today to the relative valuation of the big miners to 2009 and the move that we had then, we are looking at massive profits because the money hasn't come in. What's going on today is just lack of investor participation, mutual funds, pension funds, and all kinds of things. And what they've been seeking, the safety of derivatives that the bankers are offering.
Great. Yeah, thanks for that number. I'd heard it before, but I didn't know it came from Dun & Bradstreet. So that's very useful. And on the miners, I think there's going to be the run to gold is going to end with a huge influx of people buying mining stocks. And from my experience, and I don't think human nature changes that much, it may, but most people buy on emotion. They're not going to buy on research, even though they could do it on the internet and find out if XYZ mining has even got anything in the ground. They're going to say, I missed the boat. Gold's at 3,000. Silver's at, make up a number, 85. And I need to get in. The fear of missing out is phenomenal in currency crisis. I mean, the adage, there's no fever like gold fever, exists for a reason, which means that the people that are late to the party are going to get out there and are going to look for the cheapest penny stocks they can find. And some of these things have absolutely no merit at all. We in the trade call them moose pasture, and there's a reason, because that's all they're good for. Nonetheless, they will fly. And I may participate, I may not. I don't want anyone to get hurt, but that's the end of the market when you start seeing those things fly. And one other thing, when the market peaked in 1980, the one thing that I saw the street do, Wall Street, was not many. I'm not talking like the main brokerage houses. I'm talking people that advertised in the Wall Street Journal. And that was about the only thing going on in those days. A lot of stuff came out with two things, strategic metals and rare coins. And when people affiliated with the Wall Street Journal or willing to advertise in the Wall Street Journal start pushing Numis, I thought this has got to be it. I did not sell my gold at the top, for the record. I got out at a lousy $700, and I bought silver later, and wished I'd been more patient. But enough about me. But thank you for that input, because I had heard that number, but I never heard it before.
Thank you very much, Tom. I'd like to give David just an update too, and Rick Rule talks a little bit, more than a little bit, about the allocations that people have got, what they've had in the past. I don't want to speak for Rick, but I'm sure David knows about Rick. I'd like to, just give a little bit of an update on where we are. David mentioned earlier that he thought that he saw the high at 2,058. I believe the high was in the first quarter of 2022, futures-wise, 2,079. Okay, we're 1995 tonight. Let's call that $80 away from, let's just say, round it off to say $100 away. $100 on $2,000 gold is 5%. All right, so gold is 5% off its highs, and silver is more than 50% off its highs. Silver's been to $50 a couple of times. The gold silver ratio portrays that. We're like 86 to 1. So it takes 86 ounces of silver to buy an ounce of gold. Because of the power of low numbers here, gold, by the time gold gets to $3,000, like David says, that's a 50% move from $2,000 to $3,000. But silver's likely to be $100, $125, 5 or 6 or 7 times higher than it is now. So there's a lot of power in the silver market if it works out.
Tom, could I weigh in just on something?
Yep.
So going forward, David, and why I think it's important to understand that this could be different than the 80s. Because in the 80s, we were at the beginning of the birth of that bubble that was coming to an end, right? The derivative bubble that will sit in front of us. And because of that, when that blows, everything has to be rebuilt. And what's important about that is to go back to 1933 and understand that in 33, gold rose to a level from which it never came back. And the benefit was those held the producers, the dividend payout of those producers is what you spent because you had massive dividend cash flow. If history is replaying and we're going through another currency reserve shift, which is going to take gold to a level from which it's never going to go back, I don't think we're going to be selling the producers. We're going to be holding on to them and using the cash flow as a system rebuilds. And that's how history has replayed over years. So when I'm talking to clients right now, I'm opening both doors that maybe we take some profits along the way, but do understand that what comes next is no different than if we were sitting in 1770 and we were having a chat and I was to say, in a couple of years, you're going to have your own vote. Most people would have said, well, what's the king going to say about that? The whole system was rebuilt. And that's what's beautiful about blockchain, that we are looking at a decentralized future where everything is about to be rebuilt and recreated. That's all I have to say for now.
Yeah, that's an excellent point. And I think I want to add on to that. There was a gentleman I met at one of the conferences, and he showed a gold chart back from like the 1900s. And he said, this is not a random event. And what he talked about really was the repricing of gold, as you just mentioned, and on a basis of a gold standard, right? Because internationally, we were still on a gold standard in the 30s, but Roosevelt said you couldn't do it internally. In other words, U.S. citizens couldn't own gold, but internationally, settlement was there. And then in 44, Bretton Woods, after war, sat down and hammered out the new monetary system. So I think that's a very salient point. I really like it. In fact, I'll probably put it in my next report and I'll give you some credit for it. But it could be where you are getting these massive dividends. And that's what you spend in your, let's say, the currency side while you're holding on to a producer. I'm still favorable to the right miners, but I like both. I've always advocated physical first. I'm somewhat, into the digital space myself. I like it. I think it's here, whether you like it or not. As I think Reggie indicated, it's here and it's going to remain. And I think the fight is, if we're going to call it a fight, and I will, is between, are we really going to have decentralized finance where we, the people, get to determine our own destiny, which we have the ability to do, or are we going to see it usurped by the power elite that are vying for the fight as I see it?
Well, to think about that concept, I think we have to look at the geopolitical puzzle that's shaping up. I don't think China's ready to take over Russia right now. They're more concentrated about getting together to build what Asia is going to become. Now, if you look at the latest, they want to bring in Syria on board, Saudi Arabia, Iran. What they need is a peg. And there's nothing better for a peg that is working than gold, right? And that's a one missing piece from their trade settlement as they reshape their trading environment, right? So history is fully replaying. Whatever they choose along the way, what's needed now is the measurement for that peg. What's going to be that price? Sultan Posner put some excellent numbers just looking at energy trade, where he said, I believe it was around 4,600 gold that you require just for energy, if energy started trading in gold. So what about everything else? So we're looking at some very big numbers, and that doesn't take into account the fact that gold hasn't even been allowed to inflate. Well, look at silver. We're sitting here at $25 for the last 40 years. Gee, I wonder why.
Thanks, Jaime. I appreciate you guys weighing in like this. And, it's interesting that you bring up Zoltan again, because he's made some really interesting calls and interesting points. And just as a side note, I've tried to get him on the show, but apparently he's not allowed to do interviews. But if you guys read his articles, he makes some really interesting points. And overall, if you think about just repricing energy, as you said, Jaime, in gold, that doesn't include everything else that needs to be, repriced and rebuilt from there.
And trillions of people, billions of people on top of that, right? And the whole world is switching over to whatever Asia is going to create going forward. So I see that as an extreme, huge positive, as that purchasing power of the currency of the old currency reserve transfers to the new, and that's where the opportunity lies. And it's the one trade that Western investors are not in. So,
yeah, I mean, you made the point earlier about the 0.5% that is invested in metals, and again, I think that's going to be. We all do our best to help educate and make sure that we're not trying to overpromise anything, but just to try to educate people. And I'm sure, along with our patients in the metals, will be rewarded for that as well.
I think so. We got to do everything we can to help our brethren. Whether they want to listen or not, that's another story.
Ken DeCross, you've been waiting patiently. Did you have something to add here?
Hey, yeah, I did. So a longtime precious metals holder. I am the founder of a new layer one blockchain company. So I have a unique perspective on this. And for starting on the blockchain side, I'd just like to say that language and definition matter. And the future of blockchain is unequivocally going to happen. The fight is between a public and a private government blockchain. The fight is they don't want the public blockchains to have their day. They want to have, it's not just about government, but private, so that only they get to see the transparency.
If I can add to that, made a really good point. Are people going to accept the CBDC when their pensions are gone and the banking system has crashed? Right. So I look at this argument this way. The old Titanic is sinking, but beside us, we have this brand new blockchain ship that's already up and running for the last couple of years. That's all I have to say, Ken. But good point.
Yeah. And I mean, building in this space. So obviously I'm in this fight on the public side. I just wanted to make that point that blockchain technology itself is here and everyone's going to be using it. It's just the fight is, are they going to let us have our own money or our own opportunity? But the other point I wanted to make in the precious metals space, and this kind of goes back to what's happened with Silicon Valley Bank and everything else, I'm out here in LA, is the crypto space has gotten a taste of what I call insurance. So, the reason that we all hold silver and gold, it's not always just about profitability. It's about insuring and being able to maintain our wealth. And what's happened with Silicon Valley Bank and all the regulation that's coming in crypto is and what's happened with, the DPEG of the USDC for a short period of time is the crypto space had that moment where they're trying to figure out where to go. They can't be in the bank. The bank might not have, their deposits until it got backstopped, and they couldn't be in the USDC, and USDT because of fear for that. And so they finally had their taste of why we're all in gold and silver is they realized they have to hold their nose and just buy Bitcoin and get it off the exchanges, or buy ETH and get it off the exchanges, and just hold their nose whether the price goes up or down. And that's kind of where we're at with the silver and gold, physical market.
So Ken, what do you see as the biggest obstacle maybe, or the biggest goal that you are trying to solve in this position that you're in?
Yeah. Well, actually for me, it goes back, and this is probably something that you're not going to hear with anybody else that's in the crypto community, is we're actually going all the way back to the hardware. So hardware itself has vulnerability, and this goes from Bitcoin on up. A lot of these, you can say that you're in a decentralized system or a decentralized application, but if you're sitting on AWS or hardware that has Intel Management Engine or AMD processors, things like that, you are still sitting on centralized infrastructure, Web 2. And so what we're trying to do as far as, to differentiate ourselves is build a trustless hardware stack where there is no third-party proprietary hardware that has potential exploits. If you just Google Intel hacks right now, you'll see that there's been exploits at the chip level where they can steal encryption keys through those mechanisms. So when we're talking about a decentralized, again, I guess I'll preface where I say language and definition matter. I don't talk about decentralization. I talk about trustless, because decentralized just means that you have things all over the place. It's everywhere. Trustless and permissionless mean that no one can stop you. And so we have to take this all the way back to the hardware level and build from there to make sure we have a trustless, decentralized environment. And I think that's where the future of blockchain is going to go.
Just to speak on that, Ken, could you maybe comment on what L1 you're working on and why exactly you think hardware wallets have security exploits and what those exploits may be?
Sure. So my company is Wire Network. Wire itself is an L1 blockchain. And there's different layers, right? So I guess what I was going back to saying is that if you're building a DEX, which is a decentralized exchange, and that decentralized exchange truly decentralized if it's sitting on centralized hardware, if it's sitting on AWS, those types of servers?
I'd say no.
So I think, right, exactly. So I think that's where those are the questions that I ask when I see the headlines in crypto. Is I start asking myself, is it, is this trustless? Is it decentralized? And then I start working my way into, whether I think it's a good product or not.
Yeah.
Now, hardware wallets, that those have different mechanisms. They don't all have, Intel chips or AMD, but there are levels of security vulnerabilities. For instance, if you have a ledger or a Trezor and that gets into government hands, if they physically have that device, there is a very good chance that they're going to be able to hack into there and get what they need. So there's just levels of security. I'm looking at it from a company standpoint, like a blockchain standpoint, is how do you create the most trustless and decentralized, infrastructure that people can build on.
Could you send a link to maybe show that even if, someone gets a hold of your hardware wallet, that they could get in? Because there's things like secure elements that do deter people from this, and people spend millions of dollars trying to break these things, and they've been unsuccessful. So I would love to, hear or see an example of, someone getting a hold of my hardware wallet and breaking it, because there's plenty of companies that have hardware wallets that are very secure and are even, more secure than, physical gold, right? I mean, we're in a gold room here, and, obviously if someone gets a hold of your physical gold, then, your money's gone. So there's at least that step in the right direction, where even if they get a hold of your hardware wallet, they really need to get a hold of your seed, plus any other features that, that you're putting on top, like a passphrase or something like that. So I don't know if I exactly fully agree with kind of your argument there in hardware wallets, because, like I said, it's more secure than physical gold. And, we're here in a room full of gold people, right?
Oh, I agree. I'm just being altruistic. I agree that someone comes to your house and with a gun and takes your gold like that, a hardware wallet is going to be more secure than that situation.
Yeah. And oh, sorry, go ahead.
I'll drop some links. I'll do a quick search here and drop some links in.
Yeah, that'd be great. Yeah, thanks. No, I appreciate it. And sorry, I don't mean to come off condescending or, in a negative way. Just I appreciate the back and forth. There's also things like multi-sig, where you can have at least for Bitcoin, where you can have basically 3 keys that sign a 2 of 3 multi-sig, where, you may have a key at your house, you may have a key with a company. And sorry, can you hear me? Sorry.
Go ahead, Bugsy.
Thanks. No, I appreciate it. No, I was just going to say, even if you're worried about someone taking your seed or your Bitcoin from your home, you can set up a situation where you need, 2 of the 3 keys to sign to even spend that Bitcoin. So there's many things in Bitcoin. I don't like to call crypto. Bitcoin's a little different. But, things in Bitcoin that are very secure and cryptographically proven to make sure that no one's stealing your funds, and they're fully offline. Cold storage is extremely important in the Bitcoin realm. So I would love to jump into that if you guys want, but I'm new to the stage and want to give everyone some room. So thanks for having me.
It's funny because just Jamie Carrasco here, Jaime, on the Bitcoin versus gold, when the Rogers cable didn't work for 3 days here in Ontario, a couple of last year, I was able to fill my car up with my silver dollars, with my 1 ounce coins, because the Indian chap that runs the gas station, who didn't have ATM working, took my coins to fill me up $50 worth of for 2 ounces of gold. So the lack of electricity, I think, will always be the offset.
Silver, I hope you mean, Jaime.
Yeah, sorry.
You said 2 ounces of gold.
Yeah, right. Oh, yeah.
That's an expensive tank of fuel.
It was. But again, it's the electricity. That's why I think blockchain, anything blockchain based is still a currency, because without electricity, it just doesn't work.
Yeah. What if you're running like a Bitcoin miner off of a waterfall and had a satellite hanging out in the sky that could actually mine blocks for you and mine fully off grid, right? Those things exist. In El Salvador, they're actually mining with volcanoes. So, saying that, there's, the energy is going to go down and the world's going to go into eternal darkness. I don't know exactly if I believe maybe that, there might be power outages in different areas. But I don't believe that we're going to be going back to the Stone Age per se. And even if we do, there are off-grid mining opportunities and you can still transact. So, fun fact.
Yeah, I think Jaime was speaking more so about actually, being able to spend it when you really need it, not necessarily, mining it and having that there when you decide that you want to spend some or have it available.
Yeah, that's fair. There is off-chain ways of spending Bitcoin using things like a Sats card or an OpenDime where it's fully offline. And you can basically hand it to someone, make Bitcoin a bearer instrument, and hand it from one person to another without anyone knowing the key, and verify that the funds are what they say. And obviously Bitcoin is a very new technology, right? It's only 14 years old. So obviously you're right. The gas station clerk right now probably won't be accepting Bitcoin for the next 10 years, maybe more. But we're seeing it being adopted around the world and in a lot of poor countries that are actually relying on it to store their value. So that's kind of the way that I am about it. And I think I would have been a gold bug if it wasn't for Bitcoin. But I do see the downfall in the lack of portability, divisibility, and the fact that you actually have to have a lot of projection of power to control your Bitcoin and make sure no one steals it, for your gold, right? Like, if someone comes raid your house, I can have my Bitcoin secure, but if someone raids my house and I have gold, they can take it. And then, just obviously adding on the divisibility, portability part. It's really hard to transfer around. I can transfer Bitcoin across the world in 10 minutes. It takes me a lot of money and time and energy to bring that gold across the world as I could do with Bitcoin.
I would agree with you. It's funny because I would place more Bitcoin and silver on a similar pattern. Gold is central banks. That's for the big powerful. That's their peg. Nobody ever really won't transact. And again, I fully on board with the blockchain and with Bitcoin and with decentralized systems. So don't get me wrong. Gold, silver, blockchain. I've always said that.
There you go. Yeah, no, and again, I appreciate being here, and maybe we'll go over to Ken and I'll chime in when I can. Thanks, guys.
Yeah, I want to keep this a little fun since I was allowed to be up here. Gold and silver are my first love. So I'm going to give you reasons why that's more important than even the blockchain. So even if you look in the past 2 weeks, there's been like a solar storm that had like a solar flare from the sun that was just happened to be on the opposite side, like facing away from the Earth. Or if it was big enough that if it was facing Earth, it could have knocked out power grid across the entire world. So those are the kind of fun thought experiments that I like to have, which is there are variables that are actually real and tangible that we don't all think about on a basis. It just so happened that blast was on the wrong side, or in our case, on the right side, that it saved us. Because if you have those kind of environments, those are the situations. The Carrington event happened, just a couple of 100 years ago. Those things do happen. Our world is not as safe and friendly as we like to admit. And in those scenarios, I mean, yeah, there's worse problems that you're going to have, but in that case, I feel safe having silver and gold, and then as a backstop having a cryptocurrency.
Are you under the impression that on a solar flare like that would take out the entire globe's infrastructure of energy and electricity? I mean, if there's a solar flare, one side of the world would probably go down for a few months, sure, but that doesn't mean that the backside of the Earth that's not affected wouldn't be running, right? I mean, obviously this is hypothetical, but I just caution with arguments like that, because the chances and the probability of those are very slim, and to kind of write something off because of that is kind of a little bit silly in my opinion. And again, I don't think that would affect the entire 100% of the world, and the entire world's electricity would go down. Sure, there would be districts and countries that would go down, but they would also go back online. And Bitcoin is distributed all around the world. So, I just caution with that.
Let me add something to that then. What about the chance of somebody cutting the underwater cables that connect the world? What then?
Well, there's things like blockstream satellites that are literally floating in space right now that people are using to mine Bitcoin, like I said, through waterfalls, volcanoes, hydropower. And so, I would just recommend looking into it a little more, because I don't think those arguments are as sound as you may think they are. People can cut underwater cables all they want, but that doesn't stop Bitcoin from running, right? Not in any sense. I mean, obviously, we can argue price might fluctuate on a short term, horizon, right? I mean, we've seen it dip down about 80%, and now we're back up at 70% off its low. But over a long term time horizon, it has been the best performing asset in the past 14 years of its existence, and I personally think it's going to continue to outperform every asset until it becomes the global reserve asset of the world. But we were talking about pegging stuff to the gold. Does anyone have any thoughts on pegging to potentially Bitcoin in the future? I know its market cap is small; it's only a 500 billion, so that might be a little tricky right now. But say if it was market cap of gold, or even half of gold, could you see currencies or countries peg to Bitcoin rather than gold?
I think eventually they could, but problem is that the emergency on the monetary side is now, and you need a peg now that everybody can trust as you quickly rebuild the system, right? I think that Bitcoin had been 20 years longer, maybe, but the emergency is right now.
I mean, people thought the world was ending in 2008. People thought the world was ending in 1999. We can be hyperbolic in our explanations and think that we need a solution now, but we're seeing with poor countries, Venezuela, Turkish countries, the hyperinflation, they're using Bitcoin as a quote unquote stable asset to preserve their wealth because their countries are hyperinflating. They're also using dollars, of course, 100%. I won't, not say that, but they are also using Bitcoin. So it's very interesting.
So back to 2008, I would say that in 2008, thanks to the Chinese who bailed us out in 2008, we're able to continue. But this time they're not there. So I do think that this time is very different. Next is going to be completely different.
What happens when Russia starts basically using Bitcoin as a means of payment transfers, and the NSA basically decides, we don't like this anymore, we're just going to do a 51% attack?
Well, I mean, good luck. You have a few $1 trillion to buy all the ASICs and have the infrastructure possible to create such an attack?
Absolutely. Okay. It's the NSA. They have it.
Okay, go ahead.
And they probably even got something better than what Bitmain has, because they have government resources to do it. They probably have something. I mean, this is basically what the NSA does.
Yeah, you're welcome to make that claim, but I mean, there's no evidence to support that. So
there's no evidence to support it now, but if Russia really started to get into Bitcoin, the NSA could basically do a whole bunch of 51% attacks, and nobody would be able to figure out what the true ledger was at the end of the day. And basically, I think the effect of all this would everybody would basically have to accept the Bitcoin that the NSA basically effectively printed here, and basically, deal with, an increase in the supply of Bitcoin, which is the entire point of it, is that it's constrained, and they could shut it down, or alternatively, they could impose a transaction tax on it.
Yeah, I'm not sure.
So I think you're really depending on a game theoretic here that isn't all that hard to disrupt at the end of the day if we get into the fourth turning.
So, a counter argument would be that, Bitcoin is a little more nuanced than just saying, well, Russia could 51% attack it. That's obviously a long day-long conversation. So I won't get...
Not Russia. It would be the United States. It would be the NSA, or it could be China.
Okay.
But somebody could come out and decide, we don't like what these people are doing to our reserve currency, and they're making a way around it, and we'll just do a 51% attack on it because we have the technology to do that. And the network can't really defend itself.
Yeah, so actually the network is defended by 200 to 300 exahash of power, running completely decentralized from any governments worldwide.
Okay, and the United States government has, a terawatt or so at its disposal.
Guys, can I interject?
They'll be able to do all that.
There's no need for a 51% attack. They'll just ban it the way they ban Tornado Cash.
Okay, so
yeah, or they could have a financial transactions tax on it. Charge everybody 5% every single time you send Bitcoin. You have a public ledger. They could send the IRS agents after you, and you might be able to get around it. But the second that you start spending the money, they'll catch you, and there's no point in doing that if you're a citizen in an OECD country at that point.
Could I rebut real quick? Okay,
sure, go ahead.
Bitcoin works on a distributed node software. People that run a Bitcoin node validate all the transactions, and there's hundreds of thousands of nodes worldwide that actually enforce rules, like the 21 million cap, like the distribution schedule, stuff like that. Those things are all in Bitcoin Core. And if someone wanted to create new Bitcoin or inflate the supply or whatnot, they would have to fork the existing network, and they'd have to convince millions of people that are running Bitcoin nodes to work with them. Right? It's built on a consensus algorithm, and if you don't get consensus, then you're on your own.
Bugsy, of course. So I'm in agreement with you that you have to have. Yes, the system has an enforcement mechanism, but you can force a fork pretty easily. All you have to do is just do multiple 51% attacks, not have any idea who actually transferred the coins to whom, and basically get everybody to accept, okay, now we've got 100 million Bitcoin in existence.
So no,
it's not that hard to do for the NSA or an intelligence agency that's really good at decrypting stuff.
Yeah, so
they would have the hash power to do that.
Okay, so China banned Bitcoin about 16 times now and has been unsuccessful. So saying that, the government can just ban it, or we can just easily 51% attack something that has 350 exahash worth of power backing it through proof of work, would just encourage you to read up a little bit more on this, because, there are a lot of talking points on this. There's a lot of nuance to this. And again, it's a very long conversation, but I don't believe what you're saying is true.
I mean, the Tornado Cash, there was evidence that if they want to ban it, they can. Tornado Cash is dead. I mean, nobody's using Tornado Cash on Ethereum anymore. If the government wanted to ban it, they could. They don't need hardware. They don't need 51% attacks. They don't need hash rate. They don't need any of this stuff. They just ban it. And if you do anything with it, you commit treason. That's that simple.
You're welcome to ban it. And just like I said with China, they tried to ban it 16 times, and there's still underground mines that are pumping out plenty of exahash per day. So to say that they can just easily ban it and it's going to go to zero is incorrect, because it is a global system, not just in the USA. So sure, those miners will have to go somewhere else.
But what are those guys? What are those guys in China doing with their Bitcoins? Are they using them in commerce? Can you imagine trying to use these banned Bitcoins in commerce in China and risk getting thrown in jail? I doubt anyone's doing that. Do you know anyone doing that?
Bugsy, there are Bitcoin ATMs in China. Like, you can walk into a store here in the US and access a Bitcoin ATM. Do those exist in China? Are they freestanding? Can anybody just go up to them and use them?
Okay, well, I'm trying to stay on topic here, but you guys keep bringing up different questions and stuff, right? So, I mean, welcome to maybe, pause it here, but I would just really consider looking into proof of work, versus proof of stake. Tornado Cash was not built on a proof of work system, and proof of work with Bitcoin is quite a lot different. And in terms of gas companies and energy, fun fact that conferences are being sponsored by big gas companies like Shell. So they know what's up. They're using Bitcoin miners to flare the excess energy or excess methane and produce money instead of just flaring off methane. It's really cool. Sorry about that.
So the consensus algorithm and the mining algorithm that are being used in Ethereum versus Bitcoin has nothing to do with the Tornado Cash getting banned. It got banned regardless of any of that. And I don't see any reason why Bitcoin wouldn't be the same. You mentioned China banning Bitcoin 16 times. Where in China is it being used in commerce? Who is accepting it? Is it being used at all outside of underground casinos?
Right. And I don't have all the information for you. So, that's a good point. I'd love to look into that a little more. But, back on the topic of Tornado Cash, yes, that was an open protocol, but it was not based on proof of work. It did not have 350 exahash behind it, protecting it as a security budget. So to compare the two and say, well, they can just easily ban it and it's gone is incorrect. And I'm sorry, I guess I'll just give you something.
It's complete. They also did it in Canada. These truckers accepted all this Bitcoin. And since nobody actually accepts Bitcoin directly, they were totally unable to use it. It didn't matter how many exahashes were protecting it. These Canadian truckers were still unable to use these Bitcoins because the law superseded.
So I'm Canadian, and I was actually kind of part of that. Fun fact, all the dollars that were donated to that got frozen and Bitcoin did not. Bitcoin was actually the only funding that was given to truckers and not frozen by governments. So
Right. But the off ramps from Bitcoin, those Bitcoins were all flagged. So the Canadian truckers were unable to use those Bitcoins because they were unable to transfer them to the third party financial system because the government flagged all of them. No amount of mining could fix
it. You can flag Bitcoin all you want. I mean, I'm using Bitcoin as money, just as gold bugs were using gold as money, right? I don't need to off ramp into a fiat dollar that is continuing to inflate. I'm looking to save my wealth over time and over generations. So I don't actually need to use my Bitcoin and spend my Bitcoin to actually be quote unquote using it as a store of value.
Okay, so what were these Canadian truckers going to do with their Bitcoins if they can't spend them? I mean, that was the whole point of donating to the truckers, was so they could use them to finance their operations. But as soon as they're flagged, they can't use the Bitcoins to finance their operations anymore. Therefore, they realistically become useless.
Yeah, so this is a little bit of a time horizon.
That did show a lot of government tyranny, just so you're aware. A lot of people in Canada were not happy about that.
Yeah, so they had their banks frozen, right? They actually had their money in their bank account that was theirs frozen from them. So if people at a grocery store or on the street that were selling hot dogs did accept Bitcoin, they could use it. Again, Bitcoin is used for more things than just spending. It is also used for saving. So to have that store of value that they can use in future years or in future protests in the future, then that's valuable. But say that it can't be spent right away, I think that's a very weak argument because this is like I said, a generational approach. We're trying to, opt out of the fiat system into a more equitable and more distributed system where people can't just print dollars infinitely. So there's a lot of nuance to this. And it's not as simple as ABC, right? This is a very long conversation, so maybe I'll stop there. Thanks for having me.
Hey, I just want to bring it back around to the new risk landscape and trouble and metals, gold 2000 plus. I did have the pleasure of talking to Bob Coleman today, and I do know Reggie Middleton. At least I follow his work. Circling back around to the beginning of this conversation. I just listened to at least half an hour of doomsday stuff. And I'd like to circle back around to the beginning, where Bob was outlining what is a security and what isn't a security and how metal can be tokenized and how it can't. And I know for a fact that Reggie does have direct knowledge because, to my knowledge, he was the first to tokenize metal. It was redeemable. It was a very simple business model. And it works because I listened to Ken earlier and Ken was talking about doing, going down to layer one and the trust issues. And that's how we got into Bitcoin. But if you could separate the network, the Bitcoin network from the Bitcoin unit of account and again, you can go into the doomsday, the NSA and all that stuff. If that happens, it'll cause a major disruption just because of how worldwide Bitcoin is. And it's not just Bitcoin, the unit of account. It's Bitcoin, the network, right? It's the network. And you can actually embed things into Bitcoin. Smart contracts, for instance. I mean, you guys had the pleasure of listening to Reggie tonight, and he patented a lot of this stuff. It's in his profile, his Twitter profile. Look it up, and it has been granted by the United States government. So whenever you guys start talking about the NSA and all this stuff, I mean, you got to recognize that things operate the way they operate. And if there's going to be bad actors, at least you get to see it, in the wide open. Back to that, I'm going off here, but just wanted to get back to the tokenized metal aspect of it and what that network, I mean, it's a leap. It's a leap from being able to Bob has stored silver and somebody else, Bob Trust, has stored silver and Bob has clients and somebody else has clients, and being able to send that Bob Trust, company A, and being able to send that back and forth really does provide a lot of transparency to the market. It brings a lot of transparency to the market if you can replicate that. And I don't know if we can go back that way as opposed to Bitcoin talk.
Well, if I can add just one point on this, because it's interesting to note how Russia has dealt with the whole blockchain and Bitcoin, where last November, Russia announced that Russians have been able to own and continue mining Bitcoin, but they said, okay, but you can't transact internally. But then they turned around and they said that all international companies can use Bitcoin to settle their foreign trade, which I thought was very interesting because it kind of goes to show that the Russian central bank understands the benefit of using blockchain to work outside of the SWIFT or the centralized banking system. So from a practicality perspective, I think that's very interesting because right after that, China made its announcement about the fact that what they wanted for the currency reserve was a blockchain-based gold-backed commodity basket. So I think the discussion is within the system, but it's not being talked about because, again, I think Russia, China, and to some extent, the announcements out of Brazil, where they're looking at what's happening in El Salvador, and its deficit internally, how well the currency has been controlled within Salvador. So I believe that by what signals coming out of the BRICS, they understand the benefit of the decentralized technology and are studying it on how to use it.
Yeah, and I apologize. I took that very much micro as opposed to macro, what you're talking about. And as long as there's a trusted audit there, how come that system doesn't work? Or at least, like what you said, the blockchain does provide a more efficient system for sure.
You touched on trusted, right? I think that we're kind of, obviously having an issue with trusted banks, right? They're getting bailed out and making risky trades and leveraging their money. Our money, right? And then being bailed out. So how do we see, going back to the digital gold-backed peg, how is that any different than our corrupt fiat system we have today? That's kind of why I obviously advocate for Bitcoin. It reduces that trust. It's a trust minimized protocol. Whereas if you're pegging gold to a digital thing that says I own this amount of gold, you're still trusting someone else to redeem that gold or trade that gold or keep that value, right? They could just exit off on their computer and say, no, you actually don't own that gold. That's where the trust comes in. So how do you get past that trusted art?
I think you fail to understand that in a hard money system, you don't need a central bank. You need a treasury, right? The central bank was invented in 1913, but it really didn't come to be and be used properly until Nixon unpegs in 1975. Central bank is a component of a fiat system. If the fiat system disappears and goes back to its intrinsic value, which is zero, and we build back into a hard money system, the pegging of gold is a completely separate discussion because all the debts would have been offset back to zero the same way that Roosevelt does in 1933. So we're starting anew. The reason why you had to unpeg from gold was because we were at the limit of the amount of debt that could be risen. And then look where we're at now, right?
Right. So
again, you got to clear your mind and think outside the box in terms of, okay, if we have to rebuild the ship as the ship is thinking, that's why it's so important. There were the announcements that were coming out of Russia. What was important to me was the fact that they understood that by using blockchain, they are working outside of the centralized SWIFT system controlled by the bankers.
Yeah, that's a great point. Thank you for that. I still struggle with the part where, obviously, if you have physical gold, you have it, you own it, you can do a scratch test and you know that it's gold. Some people have been ripped off and have actually had, tungsten wrapped gold or gold wrapped tungsten and pawned off as gold. So there's a little bit of.
We actually just saw that with JP Morgan. Right.
And the bags of rocks.
Right.
Yeah.
So if you have a digital gold and say, this IOU, works out to 1 ounce of gold, you still have to trust someone to redeem that. And that brings the whole system back, and the credit system and leverage and rehypothecating that gold over and over and over.
Well, what happened there? I think the gold, you're going to have NFTs attached to the gold itself. And from the miner all the way from the distributor to the person who gets the gold, with this new blockchain technology, you're actually going to be able to follow through the supply chain where the gold was mined, how much, and pictures and ID verifiers all along the way.
Transparency.
Yeah. And so you'll know exactly what you got, when you got it, and follow it all the way through.
And if you don't sound the alarm, that's fraud. If you don't,
the last time that Fort Knox got audited, right? Fort Knox probably has zero amount of gold in it, and people say that there's gold in it, right? I mean, to audit these things, it's still a very trusted system that we have now, and we've seen how trusted systems have failed. So I don't get that, having pictures of my gold and knowing where it was, that doesn't translate to me because I don't have the gold in my hand still. I still have to trust someone.
I understand that. And that's been brought up a couple times, Bugsy. I mean, after you get to a certain point, and if you want to invest in gold or silver, like if you're talking $1 million, you don't necessarily want to hold that at home. You do want to trust a vault. What I would say is can extrapolate out to the vault providing the blockchain or accepting the token type of thing.
There's a fallacy here in assuming that trustlessness is possible, because it's not. Trust is the basis of capitalism itself. When you go to the grocery store, you trust that the strawberries that you buy are not poisoned. When you send your Bitcoin, you trust that AT&T is going to route your packets. You trust
that's not true.
That is true. You trust that AT&T is going to route your packets and complete your transaction. You trust that the processor in your phone is not backdoored. You trust that the power company is going to keep giving you power. Trustlessness is not a thing in capitalism. This is an anarchist pipe dream that really doesn't ever have a way to come to fruition.
Yeah, I'm just trying to have a civil conversation. I'm not trying to attack you or anything. Trust.
No, and I'm not trying to attack you either, but I'm saying trustlessness it's just not a thing. It's really not.
Okay, so trust minimized, right? I can trust Bitcoin far greater than I can trust Fort Knox's auditing of the gold in their cellars. So trust minimizing is definitely important, and we've built banking system based on trust, and we've seen that it's been rehypothecated and leveraged out. So how does paper or IOU gold fix that? And in my opinion, it doesn't.
Well, listen, guys, I'd like to jump in because I want to bring this back like full circle, which is we can talk about the governments and what they're doing, and this is all a probabilities-based game. That's why I own everything that we're talking about. I own silver, I own gold, I own platinum, I own Bitcoin, and all the other, even some altcoins. And I think that's how, if as an individual, that's how we have to look at this is it's so early that who knows what's going to happen. And for us, it's about getting to this next system because we know that this system is crashing. And so for me, it's diversifying inside of this anti-fiat asset class so that I don't have to pick the winner. I think that if you're in just Bitcoin or if you're in just gold or anything like that, I think that you're leaving yourself vulnerable.
And there's one thing that is certain. And what is certain is the 22,000 unbacked blockchain tokens that exist. Next month, there's going to be 23,000 and 24,000. And what is guaranteed is that they all be. Yeah, but the thing is, there's no such thing as just having a cap on Bitcoin. These things, they all, like he mentioned platinum. There's only 70 something, maybe 80 something unradioactive elements that you can possibly have. That's it. There's 23,000 things that do the exact same thing as Bitcoin. And there's not 23,000 other elements that do the exact same thing as gold. And the rebuttal against me is going to be, oh no, Bitcoin has security. Bitcoin has censorship resistance. There is no censorship resistance in Bitcoin, as evidenced by what happened with the Canadian truckers. They get donated all these Bitcoins and they can't use them. And then the hot dog stand guy, he's not going to use the Bitcoins because then he's got tainted Bitcoins, and they're going to trace that all the way down the system. And that's the biggest vulnerability in all of this is there's 22,000 of them and they all did the same thing.
Looking at it from a unit of account standpoint and not a network standpoint, Matthew, that's it. You can't shut down the network. It's really
Also, no blockchain has 350 exahash as Bitcoin does.
So it's called censorship resistant, not censorship proof, right? It's for a reason. There are ways to use it where you can protect yourself, and there's ways to use it. Like, unfortunately, the Canadian truckers used it in a poor way, which allowed them to get censored. But that's a very targeted thing that happened to them. It's not a network-wide issue.
It's absolutely a network-wide issue. If a government wants to taint Bitcoins and keep third-party financial services from giving any way for these people to spend their money, they're going to do it. And all the coins...
No. If every Bitcoin is tainted, then no Bitcoin is tainted.
Not every Bitcoin, the ones that these guys were given. And any government can censor it all that they want, as evidenced. It's already happened. And because of that, all of these cryptos do the exact same thing, because censorship resistance is the only differentiator that Bitcoin supposedly has, and it doesn't even have that, as evidenced by the Canadians.
One of the things that I think you guys are within your discussion is like you're telling me we're trying to figure out circa 1995 what shape the internet is going to take going forward. It's a new technology that's just being implemented. The one thing with gold, though, is that you also have to differentiate between you and I and whatever business we're going to do and how governments think, how China, Russia, India are going to trade. What those countries need right now for their trade is one thing they can all trust. And what they can trust is the gold that they hold within them. That hasn't changed for 4,000 years. That's the tradition of gold, right? Now, back to Fort Knox, I think the gold is there because even though the Treasury can use the gold, its custodial is under the U.S. Army. And I would trust the Army that gold hasn't left Fort Knox. It might have been smelted in 1933, but I'm pretty sure that it should still be there in Fort New York and Fort Meade, I believe, the others, because it's held within 3 forts, right? And I think that the discussion between Bitcoin and gold have to be separated between how our government's going to think in order to rebuild the system so that they can turn on their trade and their trade settlements. The other one is what will be the electronic currency to be used among people. And that's where Bitcoin and blockchain kicks in. But it's too early for it to be discussed as something that governments are going to trust within them for trade. That'll come later, 10, 20 years maybe. But for now, we need something that works. And what has worked for 4,000 years is gold and the gold that's shared within all central banks. And I think that's where you guys have to differentiate between the use of a brand new technology going forward, how will it be implemented, versus how do we rebuild this thing that is falling apart.
Yeah, I think you're making a good point, and I just want to jump on top of that, which is I think that Bitcoin and gold and precious metals, let's just throw it all in there, I think they both win, and I think they win for 2 completely separate reasons. I look at it from a practicality point of view, and you have to look at what these governments are doing, and they're throwing every bit of their fiat that they can into buying as much gold as they can. I mean, as much in this year as they've done since like 1967. So you have to look at where that money is, and you have to know that whatever they're trying to do in this next system, 100% that gold is a part of that. That's where the money's going, and you have to assume that that's where they're going to take it. Now, for us as individuals, and for other small governments that want to try, to make a difference in a different way, Bitcoin might be that option. And so there is no one versus the other for me. It is both equally. But I do think that we just have to have an understanding that both can win for 2 completely separate different reasons.
The worldwide governing bodies, the ICCC, the WC3, take a look at those and see what blockchain companies or organizations are starting to sit onto those boards. Because I think having a foot at the table is going to allow for their protocols possibly to be used.
I appreciate the chat, and everyone's obviously going to have a different opinion here. Just wanted to touch on the Bitcoin or the truckers again. I mean, again, the GoFundMes were frozen, banks were frozen, Bitcoin was not. So regardless if it was tainted or not, I can go to my local butcher or a local farmer and buy food with that Bitcoin if they accept it.
Guys, we've had enough interrupting each other. You've made the point about the tainted Bitcoin. I think the point that Jaime was saying that this new system basically has to happen to be able to help the world transact together, to help trade happen, right? To help energy change hands. That is the more salient point here that I think that needs to be discussed. And I think that is going to have a trickle down effect. It affects us on a day-to-day level on the side of buying a hot dog or whatever. But at the same time, we need energy from other countries. We need goods from other countries. And that has to happen as well.
If I could just conclude before maybe I'll step down. Jaime had a great point. I'm just going to say, he said that he trusts that gold is in the vaults. I personally don't trust my government. I don't trust that they have gold in the vaults that has not been audited since the 1900s. No way. I don't trust my government or my banks because they are leveraging my money and rehypothecating money that they don't have.
Didn't you say you're Canadian?
Yeah, so I don't trust my
Canadian. We hold no central bank gold, so you don't have to worry about that.
Yeah, that's fine. Yeah, anyway, I have a distrust in government, and to say that you trust your government, but, don't trust the fiat that they're printing is a little bit silly to me. But, I would just highly recommend looking into things like proof of work versus proof of stake, because Matthew made a comment that all crypto are the same. They are not at all. So let's definitely look into it. And again, thanks for having me. Appreciate it, guys.
I think what we can all trust is government's ability to spend money that they don't have until they can't afford it anymore.
Absolutely. This is a bigger discussion than, any particular cryptocurrency. I don't think, a good amount of our listeners came here for, the nuances of Bitcoin, even though, you guys brought up some excellent points. And, I think the point that was raised as well about the fact that I think Ken brought it up, the fact that you don't know exactly which one of these asset classes is going to win in the long run. And in some ways, kind of hedging your bets. This isn't, a mutually exclusive argument to be had. This is very likely something that is going to develop over time. That picture is going to change.
In my research, I'm watching enterprises have these large consortiums. Just an example, Hedera is having Google and L3 and all these large enterprises come on, because I'm assuming they're going to use it for their own business-to-business transactions. But what about the gold industry? Are they forming a blockchain consortium where all the gold miners and refiners are going to get together and start having a network where other people will have to come in? Does anyone know about that?
ABAX, our friend Friedlander's working on it out of Singapore.
Fantastic.
And what does that program look like, Jaime, if you know anything about it?
I looked at it about a year ago, and it's quite interesting, but they're really looking at some point, and the technology's here, where we're going to be able to monetize every ounce that's on the ground. Look at Agnico. They have 44 billion ounces on the ground that haven't come out yet. Well, I think eventually we'll be able to monetize each one through a blockchain network. It's funny, I had this discussion at PDAC this year with a couple of people talking about the technologies that are coming down the pipeline on how to use blockchain monetizing reserves on the ground, which I think is going to be needed because, the shortages are going to be huge, right? So, no, there's definitely uses for the technology. The discussions are there. It's being discussed. But again, I think it's like talking about the internet circa 1995. What shape is it going to take going forward? We don't really know, but I think it'll be exciting, and it's going to accelerate and it's going to decentralize everything, making us much more global, which is, to me, the positive of how I see things are shaping as we see this puzzle taking shape going forward.
I'll jump onto that. I know that David Morgan is involved in Load in some capacity, which is a precious metals backed digital currency. And me coming from both sides, I do believe that there is a bright future for precious metals on the blockchain. And whether it be AVAX or whether it be Load or something that comes down the road, I think that is going to unlock a lot of value in the space.
Something that doesn't seem to be talked about a lot with regard to gold-backed blockchains, which seems very clear is going to have a bright future, is part of the reason why silver was used historically as a monetary medium was due to its lower value as almost a way to divide gold. Say you had 10 silver coins for one gold coin, you could make change with gold using silver. But with blockchains, let's assume that a gold-backed blockchain has 8 decimal places. The use of silver to divide gold is really going to go away. And if you have a gold-backed blockchain, there's really no reason to use a silver-backed blockchain. And I'm very curious as to how that will affect silver's monetary status in the future.
I'll jump in that. On the monetary side, I don't think it matters. I think that there's such a demand. If we're going to have this electronic green future, which robotic future, electric car future, if we're going to have any of that, the silver on the silver side, the monetary side does not even matter. There's not enough supply. There's not enough supply that on the monetary side, I almost would be with you to think that they aren't going to make that a monetary metal just because of there's not enough above ground to make it viable.
David, did you want to weigh in?
Yeah, I'd like to chime in. First of all, the last speaker I pretty much agree with. I mean, the central banks haven't looked at silver as a monetary asset since 1873. But I would encourage everybody that's interested to go to my website and pull down the blog menu, hit the blog tab, and listen to last week's Weekly Perspective. It's called Gold Standard Equals Fiat in Disguise. And it's not my article. In fact, I highlighted this gentleman's article. He makes a pretty strong case of why, if you're on a monometallic standard, you have no reference to it, and why having a bimetallic standard is superior. Now, that's old school, and, whoever spoke, the last 2 speakers are probably making a better point. But I thought it was an interesting thought experiment at a minimum. And the other part is, where would silver be if it was a monetary asset? And I did 3 lectures on that saying, and the title of the lectures were, what if silver were treated like gold? And my point was that during the period from beginning of recorded history up until the last 130 years, the gold-silver ratio never got above 20. And the reason it never got above 20 is because both metals did the same purpose, and that was money and money alone. It wasn't until the technology started happening where we used silver for film and all the things that most of this audience is aware of, where silver under Johnson was too valuable to be money. Well, wait a minute. I thought money was supposed to be valuable. So if silver were brought into the monetary realm, it would have to be at a price level that would be astronomical. It would have to go to a gold-silver ratio that's probably pertinent to the natural ratio. That's what thousands of years of history have shown us when they both were money, which implies that you'd have a 7-to-1 ratio. And right now we're above 80, I believe. But and I don't want to just sound like silver bug and it's all about silver, because I'm bigger than that and I understand more than that. But nonetheless, it is an interesting thought experiment to think about putting silver back into the monetary realm, because with the blockchain, it's certainly more viable than it would be to take a bag of junk silver and put it on the counter and say, I got to buy this at Walmart. Although if you're in Utah, you could do that as long as both parties agree. And there are 14 states where they have reinstituted the ability for let's say a free market in precious metals, both gold and silver, to take place. So I'll stop there.
So just in terms of silver, it does have a very high inflationary supply. How do you see that kind of playing out in this digital-backed silver, or even gold, right? I mean, it's got an inflationary supply of around 2%. Do you see that as a good thing, a bad thing? Where do you stand there?
It's tough. I wrote about in the Silver Manifesto, and again, without empirical evidence, I'm smart enough to know that maybe I don't know. But if you were to go along with an increase to the money supply, we'll just use gold, which is averaged about 1.5% a year. That's the money supply, and it's increased at a very low rate. So what you actually get is a general deflation. So I don't need a financial planner when I go into the workforce to say 20 years of age, because I know damn well that when I'm 60, 70, or 80, that a dollar at that time will actually have more value to it than it would when they start in the workforce. So that's the beauty of it. Now, is 1.5% enough? The argument could go both ways. I could argue, yeah, maybe. The markets can be very efficient if they understand the parameters. And if we understand a gold coin standard, it works quite well when people have the power of money in their pocket. It's only when they take it over to the goldsmith and say, give me a receipt, and they start trading receipts. And then the goldsmith says, wait a minute, I can make up these receipts and spend them for benefit of my own personal gain. And no one's the wiser because only 1 out of 10 people come along and actually require the gold. And that's the beauty of the blockchain, at least the limited experience or knowledge I have of blockchain, is it's immutable. So if it's really in a trust mode and the depository is audited, and I mean, in today's technology, you can have cameras on this stuff. I mean, you could drill it and prove it, as it enters into the vault. And the point being is you have a trust factor that's never existed before, because the main thing with the gold standard or a bimetallic standard is putting out certificates that represented the actual metal, whereas with today's technology, it would be direct or could be direct. And yeah, you're trading digits, but it's all immutable on a ledger that cannot be, I'll say, messed with. But at least that's the theory.
Yeah, David, I'll jump in on that and say that one of the previous speakers was talking about how just all the ways that Bitcoin could be, manipulated. And, what I'll say when it comes to having silver and on the blockchain in that trust factor, trust is a spectrum, right? You're never going to get to 100% trust, no matter, what, currency that we're talking about or what system. So the goal is to get on that spectrum to a level of trust that allows everyone, the world, the economy to function properly. And I think that, besides Bitcoin, which again, I completely agree is as a trustless as you can get digitally, I think that having a metallic system on the blockchain that with audits that we can get to on that spectrum, a trusted state where, the world can function.
Yeah, I guess I just struggle to find that point. Like, I don't know if we can reach that trustlessness as opposed to something that we already have, like Bitcoin. You don't need to go to someone or have cameras or audit these things in vaults. You can audit it with your own node on your own computer and fully verify that there's only a 21 million supply. So if we start trading around receipts for physical silver or gold or anything, I just don't see that there's a way to stop people from rehypothecating and leveraging gold and silver that they don't have. I struggle with that, I guess.
Well, Bugsy, I agree with you on many points. I even sent you a private message saying so. My only pushback is that there is no trust in this system right now, and yet it is functioning. It's functioning poorly, but yet the system is still running. So I think that, again, we can create a better system. I do think that blockchain and metals are a part of that. And I do think, not for everybody, maybe not, not for you or some of the real purists, but I do think that we can get to a state where on that spectrum, it's trustless enough.
I think that's an interesting point that you kind of touched on there, Ken, is that this system is working despite not being trustworthy. Everybody in this room is aware of that. But we have to also remember that was, it started as a trusted system. And this is something that happened over time. It was just one step at a time. There was leverage added to the system. There were more dollars printed. And there's, the removal of, eggs and things like that. So this is something that happens over time. And that's, throughout monetary history, if you look back, this happens over and over. And I personally have zero faith the next system is going to be trustworthy and never be able to be tampered with or inflated in any way, because governments always need to be able to print and spend more. That's the way the incentives end up working.
What about before governments, right? Like far, far back when we were using gold and copper and silver as money, I don't believe that. I don't test or agree to the fact that governments need to print money to grow the economy. I'm more of an Austrian in this sense. I don't believe in the Keynesian where we must have a debt-based system. You can have a fixed supply system and not have to print money to grow your economy.
But it's not necessarily the government that's in charge of growing the economy. The economy is going to grow whether or not the government, has direct influence on that or not. It comes down to, the productive capacity of the people that are taking part in that economy. Where things get scary or issues arise is when, you develop an incentive structure of having people needing to get reelected every 4 years or wanting to get elected at all, and keep promising all of these issues, all of these payments, all of these programs to all of the consumers to be able to, have them voted in. So that's where I think the issue comes in. I totally agree with you that ideally we don't have, a form of big government, but you said if going back throughout time, look at Rome. They expanded the empire, and up until the point that they got out over their skis, then they started diluting the currency supply, because at that point it was currency, not money anymore. And that was ultimately the downfall of that empire. And that's happened over and over and over.
Well, and I think I know why that happens. I think we all do too. We just, don't always put the numbers together, which is in the beginning of these systems, an additional dollar spent by the government got you increased productivity, of maybe 4x. It's not until we get this late stage in the game where the dollar, the additional dollar spent by the government gets you under $1 productivity back. And so that's always I think that's why we have this repeating cycle. And I think that's why we'll never have, as long as we have a trusted system where the governments have control and have the printing press, they're always going to, that wedge to always go back to the beginning where that dollar additional spent gets you $4 in productivity. They're always going to take a bite of that apple. They just don't care about the consequences 50, 60, 70 years later when the system crashes.
Yeah. Yeah. The rent comes due, as they say, right?
and to be fair, those consequences very much so are impossible to see for most of those people at that time. And, most of these politicians are not economists. They don't study economics. They don't have a background in that. They don't understand that when you keep making these promises and spending money like that for currency like that, that is the road ultimately you get to 60, 70, 80 years later.
That's a cycle. That's a cycle, right? And what you guys are talking about is Gresham's law, where you spend the bad money and you save the good money. That's right. Talked about that. Yeah.
Hey, thanks for having me up. I'm going to jump down to listeners now, but yeah, I appreciate it. And thanks for having the civil discussion. Sorry, I may have hijacked this a little bit, so my apologies. And Ken, we'll talk later. Cheers, guys. Thanks.
Thanks for your input, Bugsy. Does anybody else have anything else they'd like to bring up?
Thanks for hosting the space.
Not a problem, Michael. Happy to have everybody, have a part of this, contribute. And for the most part, it was civil. I appreciate that. I want our spaces, regardless of what the topic is, to be, as professional as we can have them, and have some interesting discussions here. So I appreciate everybody's input. And
I apologize if I got a little hot. I've been into the whole cryptocurrency thing for over 10 years. I'm a computer scientist. I understand this stuff deep down in a way that a lot of folks don't. So when I see people misconstruing it, I get kind of hot over it, especially as we live in a banking crisis. People need to be actually protecting themselves with something that's going to actually be there to catch them. And so it's easy to get hot over this stuff. So I apologize about that.
Well,
go ahead, Ken.
Yeah. I want to give this scenario for why you should own crypto. Let's take out the hardware, the security, things of that nature. Is the reason that I'm in the blockchain space and building is I believe that we can build a better future using blockchain technology for the public. I believe that if you just look at how the governments work, I mean, you have representatives that believe in this as well. And so I think that there's going to be a stalemate or wiggle room where we're going to be able to build this future that we want because of how incoherent our governments are in general, that they're going to be, left trying to figure things out while we build up the future. And by that point, that we'll be able to reach escape velocity.
And you may have a great point, and I'm sure you do. And I think you're right that blockchain's got a lot of potential. I cannot possibly get behind the idea that an unbacked blockchain has potential because there's simply unlimited supply. I've not been able to find good arguments against that. Like I said, I've been studying this for over a decade. I was one of the weirdos. People used to laugh at me at work because I had all these graphics cards in my room. I was running 3-4 kilowatts of miners and stuff. Like, I've been studying this stuff a long time. And at the end of the day, there's unlimited supply. And I think that this banking crisis going on, people are going to have to find that out the hard way.
Well said, Matthew. And I appreciate your scenario as well, Ken. So if we don't have anything else to really touch on here, I appreciate everybody's input tonight. Bob, David, Im, Matthew, Ken, Jaime, everybody that participated. Really appreciate it, and happy to do more of these. Thanks, everyone.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.